who sets it up. If it's a trust specialist like Christina or an attorney, it's all about the knowledge the person has. And that goes to prove that even an attorney, just because someone might say, you need to get an attorney to do this for you, right? You are all equipped just through the education that Christina provides you with to be able to create your own trust. Because I had an attorney create mine, and he called it my name. And then when I asked him about what do I put for like the EIN on the trust documents, he was like, oh, you could just put your social security number on there. So I just share that with all of you to say it doesn't matter if it's an attorney, they don't even know what they're doing, okay? Or they don't care. So that's the biggest piece. But like I said, I'm part of the community also. Many of you are ahead of me when it comes to your trust documents being completed. So congratulations to you. I'm going to make sure I get mine done. This is my year to get all my documents done. But just like Christina said, I've been in the insurance industry for over 15 years. I've held different leadership positions before senior manager, director of operations. I have been on the P&C side, which stands for property and casualty. So homeowners, property insurance, all of that you can think of, auto, business insurance. That was my specialty. And so the way that I like to think of it is I was behind the scenes. So a lot of times you'll have people who are in the industry who are on the on the front end, right? And those are like your sales agents, right? But it's after something is sold to you when you need it the most, that's what really matters. And so I was on the back end where making those decisions, whether we would afford or deny coverage. So I come with a different skill set of policy interpretation and coverage analysis. So that is why I'm different from your average agent. But I wanted to be able to come to all of you today and be able to discuss. The industry calls it, well, not even the industry, I would say social media calls it like infinite banking and all of that, right? Becoming your own bank. But really, I like to call it legacy creation. And so it's one of those things that you can look at someone and they can tell you that, hey, I didn't come from a family with a lot of money, but their family is well off today. And that's because those in their past took those necessary steps to ensure that they planted that seed of wealth creation in their families. So just kudos to all of you for being on the call today. So I know many of you have been on the call. You've seen me present. You've seen me do the get out of debt presentation where I show you on and discuss how almost everyone is in debt, okay? And how we can utilize these policies to get out of debt. That is still so true. But I kind of want to shift today to just give a different perspective as well. And I'm sorry. Oh, sorry. Couldn't tell in the chat, but I want to give a different perspective as well. And don't feel like, hey, I didn't get a chance to see the get out of debt presentation. Most certainly, when you book a call, if we determine that you qualify for these type of policies, then when you and I meet or you meet with someone on my team, then they'll be able to go over that presentation with you. But I kind of wanted to share something a little bit different to give you a little bit of different perspective. There are those of you who've been on this call, you were on the workshops every month. So you probably seen this sometime last year, but you haven't seen it in a while. And there's some of you who've seen it and we've discussed it during like your one-on-one consultations when we've connected. But I wanted to be able to allow others to be able to also see this and give you just a different lens. So just give me a second because technology is not my strength, okay? So let me know when you all can see my screen. You can put a thumbs up or
we
come
can
on.
see your screen.
You got it? Okay, perfect. So give me 1 second. All right, awesome. So what I kind of want to talk about today is, well, I first want to start off talking about this concept that everyone always talks about, and they're always so, especially social media now, they're pushing like becoming your own bank, becoming your own bank, becoming your own bank. And the way they present it is like it's a microwave, like you just got free money, you just got access to, and you just go and get it, right? But what I like to talk about is when it comes to your finances and financial literacy, you have to think of it like a parachute. So when you jump out of a plane, if you don't open that parachute, well, you know what happens. The only way to survive is to open the parachute. So that's kind of what you have to kind of think about, like your mindset when it comes to your finances And having your money, I'm very old school. So I'm very like, not your typical agent where I like to be able to have my money in different places, but it feels good to know that I have my money and a lot of my money sitting in one particular place or several places that are the same because I have a few IULs. And so does my daughter, where I have money sitting somewhere that I know is safe. So if whatever I'm dipping and dabbing in with like the stocks or crypto or ETFs or anything like that goes under, I at least have something where I'm not starting from scratch. So, what I want to talk about is I know a lot of us, I can't be the only one who has said, if only I had $1 million, or if someone gave me $1 million, or you've said things like, if I became a millionaire, right? So if you've said that, drop a one in the chat because I know I can't be the only one. Because if I'm the only one, that means all of you on the call are already millionaires, and kudos to you. Okay, but we say these things and we don't even realize we are already living in it. We just don't see it. And why don't we see it? Because money is always moving. So many of us are already millionaires over and over, and many of us are already on the route to being millionaires, but we don't see it because, like I said, money is always flowing. So when you look on the screen here, you have three tanks, okay? You have the lifetime capital potential tank, you have the risk tank, which I like to call the evaporation tank, and you have the savings tank, okay? So out of the three tanks, as you can see, the lifetime capital potential is the biggest tank. Why is that? Because it represents all the money that you're going to make in your lifetime, okay? But if you notice, the lifetime capital potential tank isn't filled to the top. Why? Because like I said, money is always moving. So just to kind of give you just like a basic understanding, right? You get your money comes in, you're getting paid, right? It's going through the lifetime capital potential tank, but it goes down through the inflow pipe. But before it goes anywhere else, as you can see, it's not moving anywhere else right now. Why? Because it has to make a pit stop. And what is that pit stop? If you look right here and it says tax filter, you see how there's an opening and there's a drip about to come out? Where it has to make a pit stop there first. And that tax filter represents your business partner. Who is your business partner? It's the government. However you like to cut it or whatever you like to say, they are your business partner. You do all the work, you go to work, you make all the moves, you wake up in the morning, you slave and do everything you need to do, but they are there ready to collect from you, okay? So they get their cut, they take their money, and then whatever is left typically goes through the after-tax cash flow pipe. And what that does is it funds your current lifestyle. Well, what's your lifestyle? Your lifestyle is your mortgage, it's your rent, it's going out with the kids, it's buying clothes, it's buying food, it's paying your cell phone bill, it's those subscriptions you have, it's going on family's vacations, it's your car note. All of that is lifestyle. Okay. And so what happens is the rest of the money that's left with you, it goes through that after-tax cash flow pipe. And then as you can see, it goes out. And again, there's no bucket under the tax filter and there's no bucket under that pipe. Why? Because once the money is gone, it is gone. Okay. And so what a lot of us fail to do, I know I've done it in the past. I was talking to a client this morning, and many of you have heard this, and whether it's one-on-one or during these calls, because I don't have no shame in my game, okay? Because when people see me, they assume that, oh, she has all this knowledge and she got up here. And it's like, no, I came from an immigrant family, so they didn't have the knowledge to give me. And when I was 19, 20 years old, and I was having my little paychecks, I was spending it all because I was like, oh, I'm gonna get Social Security. I literally was like, oh, no worries. They're going to give us Social Security. I didn't even know what Social Security really was. I just knew they were taking money out my check, and I felt like it was going into a savings piggy bank for me, and I was going to get all this money. So I just kind of lived YOLO. And what I wasn't doing is I wasn't thinking about the future, Gerda. Okay. And that's the same thing when I got refund checks. I don't know about y'all, but I used to get refund checks from college, and I used to think I was balling. Okay. I was on autotrader.com. I don't know if maybe it's too far back, but it was autotrader.com. I used to go on all the time. They had the little booklets that you could get at the gas stations. I used to be on AutoTrader looking for a Dodge Intrepid. Yes, I was. Okay. And so what was happening is I was using all this money because I didn't have the financial literacy and I didn't have anybody to educate me on what it was. And so what I failed to do, and what we all should be doing, is this is typically how cash should be flowing, right? The money should be coming in through our lifetime capital potential. And then some of you who are on this call, or many of you, you have a qualified plan. Well, what's a qualified plan? Or you have several. It's the Roth IRAs, the IRAs, the SEPs, the TSPs, the 401ks, the 403bs. All of those are qualified plans. So when you get your income, it comes in at the top, and then some of it is dropped into your qualified plan. Whatever is left over goes through your lifetime capital potential. It makes a pit stop at the tax filter because the government has to, your business partner has to get their money. The rest of it flows through the after tax cash flow. But then some of us should be having, well, not some of us, all of us should be having money going up through the future lifestyle. And essentially, some money should be going in the investment tank and some money should be going in the savings tank. So when we ultimately retire, this is really the whole gist of it. We're really working so we can have a better future. But a lot of us, life just be lifing and we're working to just survive the day. Okay. But what happens is when we retire, we should be able to turn on these two distribution valves and we should be able to fund our lifestyle, which would be our future lifestyle. And at that time, it would be our current lifestyle, where we're living either the same way we're living today or better. Okay. And I don't know about you, but I'm comfortable with my lifestyle now. But I'm going to be honest, when I'm like 68 years old, 69, 70, I want to be living a better lifestyle. Okay. Like a better lifestyle where I'm the grandma that is always traveling. And they're like, what is she always doing? She always traveling, giving all the grandkids money when I see them. And I have different accounts for the grandkids. I want my lifestyle to be better. And so essentially that is the gist of it. But what tends to happen is when we get this money and it comes in and it comes through, I'm going to kind of turn this on. A lot of us, when the money comes in through here, we have the qualified plan contributions where they say, hey, dump that money into this bucket because when you retire, you're going to have a nest egg kind of waiting for you, right? But what many people don't realize is these qualified plans were created back in the 1980s. So it's not something that was here forever. It was not. So those baby boomers, they started working and they didn't have something like that, okay? Then why was it created? Well, the qualified plans were created as a way to entice people from cash value life insurance policies because so many people were putting all their money in these policies as private hidden reserves because the money was protected. And you had people who had $100,000 death benefit policies, but they had millions sitting in the cash value. And so the government didn't like that. So they tried to create the qualified plans to entice people to shift from that and basically put their money in here. And I also shared with the client this morning that the 401k actually wasn't even created by the government. It actually, and it wasn't started out with the name 401k, is actually created, I forgot his name, but it was a gentleman who created it for his company specifically. And he just did it to be able to help his employees have another way, kind of like force them to save money. So it was just another savings account that they would have that would give them income in their retirement, just like their Social Security and their pension. So they would just have something else. But what happened is the government loved his idea so much. And one thing we know about the government is when they see they can benefit, they will take it with a heartbeat. They loved it so much that they took it and they adopted it. And even the founder, and you can look it up, even the founder of the 401k, he stated that the 401k has transformed into something that it was never intended to be. Okay. And so now when people talk about retirement, they talk about retirement as being synonymous with their 401k when really it was just supposed to be just another savings vehicle for them. Okay. So when you get that money, you get paid and they'll tell you, okay, I'm just gonna randomly pick some up. Valencia made $1,000, and they'll say, Valencia, put $200 in this bucket, okay? And Valencia, we're only gonna tax you on the 800 that's gonna come through the inflow pipe. Valencia is excited because she's like, okay, I'm gonna pay less taxes, and I got money going in this bucket right here for $200. Well, what you don't realize is that all you're doing when you're funding your money in these accounts is that you're kicking the tax can down the road. Okay. When they say tax deferred, it just means tax postponed, but they're also deferring the tax calculation. Okay. Which means if the government chooses, like today, let's just say, you know that today you might look at yourself and say, okay, they're going to charge me 30% tax. Well, you don't know what they're going to charge you in the future. And if the government decides they want to charge you 60%, and you might be thinking, Gerda, that is crazy, 60% taxes. Well, taxes were started in 1913, and they were started as a result to get the economy back under control after the Civil War. Income tax was supposed to be a temporary thing, okay? And they just created in 1913. Well, from 1913 up to 2025, if you look at the average tax rate across 1913 to 2025, it's 56.58%. And at one point, taxes were as high as 95%. And I'll show you guys shortly as we talk. But the goal was to basically get people to entice them to get from these cash value policies to dump their money in here. But they don't tell you that when it comes time for you to collect the money, your harvest, they're going to tax you, and they're going to tax you what they want to tax you. But I don't know about you, but I'd rather pay taxes on the seed today than pay taxes on the harvest in the future. Okay. So let me see. Oh, yeah, yeah. Oh, absolutely. In the 90s, it was actually 95%. And I'll even show you guys where one year, I believe it was 1941, it was 80% taxes on anyone who made over $5 million. This was 1941. 1942, they raised the taxes to 88% on anyone who made over 200,000. You went from 5 million taxing people at 80% to the very next year taxing people at 88% who were making over 200,000. Okay. And they did a lot of these jumps that you'll see when it's 95% or 90% or 80% or here or there is because a lot of it had to do around times of war. I don't know about you. Okay. Uh, it's a little shaky nowadays, and we don't really know what's next, what's going to happen, what's going on. I know they're trying to distract us with Diddy and Jay-Z and all these other things that's happening that we're not realizing. BRICS countries are coming together and they doing this, the dollar's being devalued, and I mean, it's just crazy. But it's one of those things where it's like, what then do we do? So when we put all our money in here, one thing I do want to highlight to you is if you notice between the two tanks, one of them has a lid and one of them does not. Well, the reason why is because the one that doesn't have the lid, I like to call it the evaporation tank, is that you can wake up tomorrow morning, God forbid, knock on wood, but you could wake up tomorrow morning and all of that money be gone. And there's nothing that you can do about it. There's absolutely nothing that you can do about it. And so, like I said, I'm not saying or here to when we talk about the becoming your own bank, it's not saying take all your money from one place and dump it over here. What it's saying is if you're going to have your money spread out, you need to make sure you have something in your arsenal that you know without a doubt that your money is safe and it is protected. So God forbid, if you lose everything else, your family doesn't have to start from zero. And let's just say you don't lose everything. Thank God. We pray that you don't, but you're not here anymore. We know that the next generation doesn't start from zero and they have something where now all these trusts that you're creating, you really can fund the legacy. And now you really can say you are creating generational wealth. It's great to have the paper, but if you don't have anything to back the paper up with, then you really don't have anything. So kind of what Christina talks about, you create these trusts. Now you got to transfer the assets into the trust. Okay. So it's similar. It's the same exact thing. So let me take this off and all right. Perfect. So I want to just kind of go back real quick. I'm just going to kind of go back to my screen real quick because I want to show you something. So when we go here, you have these two tanks. Okay. And like we talked about, you have this first tank here. And this is where you're dumping all that money. So the analogy I gave someone this morning is think about it like you have a well in your backyard. You dug the well, you know how deep the well is, and you are like, I'm just going to use Jenna. Jenna says, I got a well in my backyard. I dug the well. I have the magic ladder to get down there. When I retire, I'm the one going down there. No one can get to it. It doesn't even matter. It's safe and secure. Every time you get paid, you're dumping your money down there. Let's just say Jenna has the 9 to 5 and she gets a company match. And every time she dumps in 200, the company dumps in 100. So now she's dumping in 300 every time. So then the time comes for Jenna to go to the backyard to go down her well. And she's like, yes, I'm excited. I got my magic ladder. I'm climbing down there. No one has ever gotten to it. My money is safe. Jenna goes down there, and when she gets down there, she notices on the table that All the ones are neatly stacked. You have fresh, crisp dollars, ones, fives, tens, 20. Everything is stacked beautifully. But then when you turn on the light, you notice someone sitting there on a chair. And they're like, hey, Jenna, you're like, who are you? What are you doing? I'm about to call the police. They're like, you don't, no need to. Because I'm here to collect our money. And you're like, our money, what do you mean? It's our money. Why? Because if you think about it like a business, the government is the general partner. You are the limited partner, even though you did all the work. So when they're in there, if taxes go down, they're going to take less from you. But if taxes go up, they're going to take more. And again, why did I express and talk about the 95%? Because it can happen. One thing we know about history is that history can and does repeat itself. Not always, but there are certain instances where it has repeated itself. Okay. If it didn't, you wouldn't have all these financial gurus looking at trends when it comes to the market, right? And they'll say, oh, the market went up, but it typically does this. And this is what history repeats itself. So if we can go up to 95%, who's to tell you when you retire in 30, 40 years, 20 years, 10 years, heck, the way the world going, it might be 5, who knows? But who's to tell you that when you go, that money is not going to be taxed the way that they want to tax, and there's nothing you can do about it. Okay. So that's one thing, the taxation. But then you also have to worry about the market volatility, which is why when you go look, sometimes it's up, you go look, it's down, you go look, it's up, you killing it, you go look, it's down. Okay. The other thing you could say is, okay, well, I have a Roth IRA. Oh, that's perfect. Well, the reason why you're not paying taxes on that Roth IRA is simply because it was funded with after-tax dollars. So you already paid the taxes on it. But the fact of the matter is, whether it's a Roth IRA, a 401k, a 403b, TSP, it doesn't matter. They're still in the same tank, which is the evaporation tank, which means same thing. You can wake up one morning and everything be gone. Okay. And so again, what I'm saying is, I'm not saying don't have your money here. What I am saying is, if you do have like a 401k, don't be like me, how I was back in the day where I used to contribute as high as 12% and the company was only matching 6%. What I recommend to you is, if you do have a 401k, yes, contribute, but I would say contribute to whatever the company match is. If they're matching 6%, contribute 6%. If they're matching 4, do 4. Right? And so that's one scenario. You have money sitting here because you want to have it diversified. But then if you might be like, oh, I got money sitting in the bank, I'm good. Well, you have money in the bank, but we do know that certain accounts, they're there too. If they weren't, you wouldn't receive that nice little statement from your bank at the end of the year or the beginning of the following year when it comes tax time, because they want to know how many capital gains, how much interest did you earn? They want to know that. Right? Because they're there. And there's also other areas that you can put your money in where you don't have the business partner in, right? However, even though there are other vehicles where you can put your money in, if we really start to think about becoming your own bank and we really start to think about infinite banking, we need to start thinking like the bank. Okay. And the bank's biggest thing is they are focused on making money. Okay. And one of the things they love is that compounding interest. And they love making money while they're using someone else's money. And whose money are they using? Our money. They're using our money to go make money. So when you start saying, I want to be the bank, you need to start thinking like the bank. And what people don't realize is that the biggest consumers of cash value policies is banks and other countries. Okay. That's why they have bank-owned life insurance called BOLI, bank-owned life insurance. You go look at your bank account now, you go to your website now for your cash. What are you going to see? You're going to see FDIC insured. That's insurance. Okay. They're insuring your money. Okay. The biggest consumers of cash value policies are other countries. One of the biggest ones are Saudi Arabia, China, because they understand the power of what these type of policies are. And if I share with a client this morning too, people don't even realize insurance has more money than the governments. Insurance has more money than the governments. And people sometimes may say, oh no, the government got, no. The insurance companies have more money than the governments. And that's a fact. Okay. That is a fact. They have so much money that if they wanted to, oh, what was that? Yeah. Yeah. Wow, Angela, because people don't know that. It's like The government is looking to the insurance companies to help insure them. Okay. I had a client who had to do unemployment insurance, bank-owned life insurance. Everything is insured. And people also sit here and think, one thing I want to throw out too is when we talk about becoming your own bank, people think that this concept has been around for maybe just 100 years. Why? Because a lot of insurance companies, not all of them, but a lot of them have been around for over a century. The ones I work with have been around for over 130 plus years. But people hear that and they're like excited, like, wow, they have longevity. No, insurance started back in the 1700s. Okay. And it started from the Presbyterian Church because they wanted to ensure that the family of the priests were taken care of. So that's how insurance started. So when you talk about generational wealth and you talk about these wealthy families that have legacy, it started back in 1700s before we even had government and we had Democrats, Republicans, and all this other stuff. No, 1700s. It's been around. So insurance is not a new thing, but it's something that those who are wise, who have opened up their mind to understand the power of what it is and what it will do for their families and their legacy, are the ones who jump on it. Whereas, and over time, the world has kind of transposed it to be like death insurance. So I love the fact that now it has a new state like becoming your own bank or infinite banking and all of that. But it really means nothing if you really don't understand how to really utilize and maximize it. Okay. So even though you can put your money in those safe tanks, to get back to the tanks, even though you could put it there and you have money, some is sitting in here and you feel like, okay, I'm very diversified. You have to think about what's next. Because even if you have money sitting in here in these accounts, I'm going to use my stylist. And yes, y'all, I still do not have a stylist. Okay. Gerda, it's been a year. You need to get a stylist. I know. Okay. Still don't have one, still using the mouse. So it's still going to look like scribble scrabble, but you're going to get the point. And I promise y'all, I got beautiful handwriting. Okay. So even when you have this money in the savings account, you might think, okay, I have a good mix. I have a 401k, I got a Roth IRA, I got some money in the savings account, got some money in a CD. And it looks good. It's a good mix, right? You might even have some crypto, right? Throwing XRP out there just because I got in on it when it was 19 cents. So if you don't got it, get some. But you have a really good mix here. But then let's just say you need something, okay? Now you need to go get something. And when you go, let's say you have 100K in this savings account. And you now need to borrow 30K to go get a new car, right? And that's okay because it's your money. You do what you want with it, right? So now you take out 30K, but what are you left with? Oh, that look like a 30. Okay, that's a zero. What are you left with? You're left with 70K in the bank that's earning interest. And every day that goes by that you are working to try to save back that 30K to make it to 100, you are losing the opportunity of the interest you could have been earning. Okay. Because once that 30 is gone, it's gone. So you can say you're going to get the 30 back. No, you're not going to get the 30 back. That 30 is gone. You're going to get another 30, but that 30 is gone. You have forever lost the opportunity to earn interest on that 30,000 that you took out to go get that car, or whatever it is you needed to go get, period. But if you have this same scenario and you have it in something like a cash value policy, okay, now we're thinking about how are we the bank. Now you have that same scenario, and this green represents the money that's in your cash value of your policy. You have that same 100. You decide, I want to go buy a new car. You take out that 30K. Well, your cup, if you guys remember what I talk about, like with the cup, your cup has 70K remaining. What do I mean by cup? The way I look at it is the 100K, you can think of it like your statement balance. Okay, what's your statement? What's on the statement? You took out 30,000 to go buy the car. You're going to keep earning compounding interest on the statement amount, which is what? What is the statement amount? If you guys just drop the number in the chat, just so I can make sure people are following so far. Like, what is the statement amount you're going to be earning interest off of? Yes, you're going to be earning interest off of the 100K. But your cup, what I like to call the cup, you only have 70K in it. Why? Because you took out 30K to go buy the car. Okay. Now, that's fine and dandy. And some people like to say, when you look on social media and they're always like, yeah, you take your money, you take it out, and you don't have to pay yourself back and do all of that. Let's correct that. You are not taking your money. You are borrowing the insurance company's money. Okay. But why are you borrowing the insurance company's money? The insurance company don't care. They'll give you what you want. Why? Because that money you have, that 100K, imagine that it's in a cup and the cup is inside of their kitchen cabinet in their house. You can't get to the you can't, even if you wanted to leave and run, it doesn't matter. The cup is in their house. So if, let me see. If Valencia has 100K in that cup and Valencia says, I need 30K to go buy this car, they're going to say, absolutely, Valencia. They're not going to ask Valencia for bank statements. They're not going to ask Valencia for pull her credit. They're not going to do any of that. They're just going to give it to her, right? And why is that important? Because you know your banks, the banks that we put the money in, we don't ask them for credit checks, but we sure enough set it up on direct deposit. And once that money hits their bank account, they are using our money and they are spreading it out to 7, 8, 9 different people. They're giving us 1, 2, 3, 4, if you're lucky, 5% on our money that's sitting in their bank. But then they take our money and they go loan it out to 8 different people and they charge those 8 different people different interest rates. One might be getting charged 24%, one's getting charged 15, one's getting charged 10, one might get lucky, get 4, but they're making money 8 times over on our dollar. But then when we say, hey, I just need 10,000 or I need 30,000 to go buy this car, they're going to say, well, give me your credit report, how long you've been with the bank. We need paycheck stubs and all of that. Okay. So this is important because they don't have to produce documents to get our money. So it's a similar way when you think of, okay, now I'm the bank. My money is in this account. The insurance company is, I need 30,000, and the insurance company is just saying, okay, here you go, Paul. They don't care because the money is inside of the account. If you don't pay them back, all they're going to do when it comes time for your family to collect the money is they're going to say, hey, I gave Paul 30,000. He had 100 in this cup. It's time for you to collect his money. I'm going to take the 30,000 out and give you whatever is remaining. Why do I say whatever is remaining instead of the 70K? Because by the time it's time for Paul's family to collect the funds, it's no longer 100K. It's way more than that. Okay. So that's why I wanted to highlight. But when you think about it, your cup is here, is the 70K because you took the 30 out. You have the 70K remaining in your cup, but you're still earning interest off the 100K, which means if you were earning 5% interest by next year, your cup is going to have 100 and your statement is going to show $105,000. You've earned $5,000 worth of interest. Why? Because you got 5% on that 100K. Where does that $5,000 go that you just earned? The statement that now says 105, but that 5K that you earned, it gets where? It gets dumped into your cup. So now your cup has 75K in it. And this is only if you didn't pay yourself back. Okay. This is only if you didn't pay yourself back. It's now 5K. But let's just say Paul got that 30 and by the end of the year, he's like, oh, I got a bonus. I paid 10,000 back. Well, now Paul's balance went from 70 to 80 and he still earned that 5,000. Now he has 85,000. So the reason why I always tell people when you have these type of products and you're serious about becoming the bank, it's one of those things where you want to respect your family bank and respect yourself more than you respect someone else's bank. What do I mean by that? Because if you went to Bank of America and you got a loan and I said, Rodney, let me borrow $50. You might say, nah, Gerda, I got to pay this, I got to pay that, and I got to pay my loan, my car loan back. You're going to make sure that's the priority. So I tell people when you become the bank, you now need to respect your family bank more than you respected the other banks. So if you take money out, have a plan to pay it back, right? And the great thing about these policies is that the payments are unstructured, which means unstructured loan payments. You go to the bank, you take out a $30,000 loan. What are they going to say? Your first payment is due on this date and is this much. And then when you pay that amount, a certain goes to the principal, a certain goes to the interest, right? Well, with these type of policies, you took out that 30,000. It's up to Paul to decide when he's going to be paying the 30 back. Paul could say, I got to do this or that. for the family, and I gotta expense this for this year, but I get a big check in, I don't know, I get a settlement check in February of next year or July of next year. That's where I'm gonna dump in 10,000 back and pay myself back. Paul has a plan, right? He has a plan to pay himself back. They're not going to say, oh, that's too late. No, he has a plan to pay himself back. Okay. And so, why do we want to look at it here versus like a savings account? Because remember, you take out that 30K from the savings, you lost the opportunity for the rest of your life to earn interest on that 30K you just lost. Whereas in here, you're earning money on the same dollar. Okay. And why do I say earning money on the same dollar? Because if you use it on something that's gone forever, which is okay, you might want to go on a family trip, whatever the case may be, that's okay. It's not making any money unless you go on a trip that's making you money. But if you decide, okay, I took this 30, I put it down on a rental property, and now it's getting rented out, and I have different tenants in there, and I'm getting rent. Well, you made money off the same dollar because you're earning interest. You didn't lose the opportunity to earn the interest when you took the 30 out, and you're earning interest on the property now that you have tenants in it. It's the same dollar, using it over and over. So I just wanted to just emphasize that, because the other thing I want to talk about that I don't think I've talked about before is that someone had asked me before, they were like, hey, Gerda, but when you take the money out and you now become your own bank, you take the money out, you now you're taking a policy loan, right? What's the interest rate? Well, it depends on the time what the interest rate. I have never really seen an interest rate go higher than 5%. But let me show you why the interest rate doesn't even matter when it comes to the interest rate when you're talking about these type of policies. So let's go back to the 100,000 example. So we have $100,000 sitting in our cash value policy. Okay. You then say, Nia says, I'm going to take out $10,000. Okay. Nia takes out 10K and she decides to go do whatever she want to do. Nia said, I'm going to go on a trip to Seychelles because I've been working hard and I deserved it and I earned it. And that's 100% okay. Because the insurance company is not going to ask you what you're going to do with this 10K. They don't care. So now Nia takes out the 10K, and let's just say Nia is paying 5% interest for that loan, that policy loan. Are y'all following me so far? Put like what do people say? Put a 1 in the chat or something if you follow me so far. Okay, perfect. So again, just to recap, 100,000 in the cash value portion, and we're going to assume the cash value is this green right here, okay? So Nia takes out $10,000 to just go on a trip to Seychelles. The policy loan is at 5% interest rate. Okay. And she's taking a policy loan because she's borrowing it from the insurance company and they're giving it to her because she has 100K in her cash value. They don't care. She takes it out as 5%. Well, 5% interest on 10,000, and somebody correct me if I'm wrong, is $500. Okay. Now, what's so great about it is the interest is simple interest. What does simple interest mean? It means it's 500 is 500. Okay. That's the interest. It's not like when you go get an amortized loan from the bank and you pay over time and it's like, man, over time, the amount that's going to the interest declines, but it's like, good God, in the beginning, that interest is eating up your payments. This is not what that is. She has 5% interest on that 10K, that's $500. Okay. Let's say Nia got the policy today on March 28th, okay? Which means the policy periods are not calendar year, okay? They are rolling 12 months. Nia gets her policy today, March 28th. It's going to run from March 28th, 2025 to March 28th, 2026. That's her policy period, okay? This $500 that Nia took out, I'm not $500. This 10,000 that Nia took out, Nia says, "Ooh, I just needed a vacation. I don't know when I'm gonna pay it back, but I do have a plan. When I get my bonus here and when I do this here, this is my plan." Whatever plan Nia comes with great. But this $500, Nia wants to make sure she pays that before her policy period anniversary. When is her policy period anniversary? It is March 28th, 2026, okay? Because remember, she got it today. Her policy period is for 1 year, to a rolling 12 months. Her anniversary date is March 28th, 2026. What does that mean? That means that even though Nia doesn't have a plan on how she's going to pay that 10,000 back, she has a plan. She knows she's going to pay it back, but she's like, not this year, Gerda, because I got to do this, I got to do that, and I got to do this. So not this year. What I tell all my clients is you always want to pay yourself back. Always pay yourself back, respect yourself, and respect your family bank. But if you're like, this ain't the year for the 10K to be paid back, Nia needs to make sure she pays that $500 back before her policy anniversary. Why? Because if she doesn't pay that $500 back by the time her policy renews on March 28th, she basically is going to pay interest on the interest. Does that make sense so far? Which means, let's just say Nia paid the $500 in November of this year. Okay. Which means she paid her simple interest. She paid the $500 in November. Well, when her policy renews on March 28th, 2026, so let's say it's March 29th, 2026, Nia still hasn't paid that $10,000 back. She still has it outstanding because remember, all she paid was her $500 interest before her anniversary. But now March 29th hits and Nia still has this $10,000 that she never paid back. Well, what is the $10,000 being? What is the interest rate for the policy loan? It's 5%. And guess what they're going to do? They're going to apply 5% to the 10K, which means from March 2026 to March 2027, Nia has 12 months to pay back what? $500. If Nia says, Gerda, 2026 ain't even the year for me to pay back this 10,000. Or Nia might say, you know what? I'm not paying the 10,000 back because I worked hard and these kids are just going to have to get the 10,000 out of the death benefit because I worked hard. But Nia says every year, I'm just going to pay what? The interest. So that's why I always tell people, if you're going to do anything, always pay yourself back because remember what we just talked about. If Nia doesn't pay this 10K back, what does she have to wait for? She has to wait for the drip of the compounding interest, right? Because she won't have the full cup, okay? And what do I mean by that? If she took out the 100K and she dropped it down to 90K, right? And let's say Nia saw something, and we're going to forget about the drip of the compounding interest for now, but let's say she saw something for 95,000 if she want to put it down on an apartment complex or whatever, some big investment deal. Well, Nia, you only got 90,000 in there because you still haven't put the 10,000 back and you haven't earned your compounding, your drip yet from the interest. Does that make sense so far? So that's why I always say pay yourself back so you can have access to the full cup amount. Okay. So when we kind of go back here, if Nia decided every year, she's like, I took out that 10, I'm just going to pay the 500 every year. Take the 10K. Okay. Well, that works because every year Nia is just paying the interest. Well, what happens if like in year 3, the policy loan interest rates are just dropped to 3%? Well, guess what? It's $300 for that policy period that Nia is going to have to pay. Okay. Here's another thing. Let's just say 4 years from now, Nia decides, oh my God, I need another 10K. Okay. By this time, her 100K cash value has grown. Let's assume it grew to 150, 160. But we're going to ignore that it grew. We're just talking about the policy loans. Let's just say, yes, it did grow to 160. But Nia says, oh my God, I need to take another 10K out because I don't know if Nia has kids, but I'm going to say she does. But let's just say she's like, my baby graduated and I want to do $10,000 on a car or whatever the case may be. She takes out another 10K. Well, when she takes out the other 10K, let's say it's 5 years from now, and 5 years ago, she still ain't paid this 10,000 back. She's just been paying her 500, and that's okay. But let's say 5 years from now, Nia takes out another 10,000. Let's just say it's at 5% again for that policy loan. Well, that's $500. So remember, her policy always renews on when? March 28th. So now we're 5 years later. It is now 2030. Nia still has only been paying her $500 every policy period because she decided she's not paying that 10K back yet, right? But now Nia took out another 10K, so now she has a total of how much loans out? $20,000. But Nia's probably like, Yeah, I'm not gonna pay that back now because my business, I think, is gonna launch and it's gonna pick up speed and I'm gonna pay it back and do whatever. But if it doesn't, they could go ahead and take the 20K out of the death benefit when they give these kids this money. Okay. But what now does Nia have to make sure she pays every single year before her policy renews? Now she has to do 1,000. Why 1,000? Because remember, she never paid back the first 10K, and that was at 5%, 500. She took this policy loan out 5 years later. She took out 10,000. That was at 5%, 500. So that 500 plus that 500 is $1,000. Does that make sense so far? But Nia has $20,000 outstanding in policy loans, but she's paying her interest at least until she figures it out. And I'm just going to leave you with one more thing. If Nia were to say, yes, I got 20,000 in policy loans, boom, that refund check came through, or I got an unexpected check from the IRS because I got a new tax person and they got me some money back. I paid $5,000 towards my policy loans that I had. So now she paid $5,000. And let's say we're in 2031. She's paid $5,000. Okay. She went ahead and paid her interest of the 500 for the first loan, 500 for the second loan, and then she decided she's going to pay 5,000 on top to pay for one of the out of the total of the 20. So now that leaves Nia 15,000 that's on her amount that she borrowed. She's already paid the 1,000 for the interest within the year. So now policy renews on March 28th, and let's say now it's March 29th, 2032. Nia has $15,000 worth of loans. And let's just assume the loan rate, the interest rate for loan policy loans at that time is 5%. Well, Nia is going to be paying 5% of 15,000 now. Does that make sense? So no longer will be 1,000 because it's no longer 20,000 that's outstanding. She's going to be paying 5% on 15,000, or if they change it to 3%, she'll pay 3% on 15,000, or if it goes to 2, or if it goes to 4, whatever the interest rate is for the policy loan at that time, and her outstanding amount is what she will have the simple interest for. But you have the whole time of your policy period to pay the interest. If you're going to pay anything back, pay the interest. So I hope that made sense. If it did make sense, I always like to just give people a little bit more because these are the things that you don't hear about. And these are the things. And how do I know? Because I've been in insurance 15 years. And when I got my first policy outside of the employee-sponsored insurance policy, it was from someone who was on the third floor who worked for the same insurance company as me. And he sold me my term policy. He did not explain to me any type of cash value policies. He didn't even ask me what's my goals. He didn't ask me nothing. He just was ready to give me that $1 million term. And I walked out there feeling great because I listened to Dave Ramsey and he said, buy a term, invest the rest. And I thought I was big balling because I had $1 million term. And then it wasn't until I started going further and further. And mind you, I'm working for a Fortune 100 company that just so happens to be an insurance company, one of the top insurance companies. If I mentioned the name, you'd be like, what? I'm going to go ahead and say it. Liberty. Okay. Liberty, 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 liberty. Yes. So I was working there in senior leadership and I had none of this knowledge. And I don't want to fault him because he may not have had it, they may not have taught it, or he may have known it and didn't want to share it. But everything that I teach or I explain to my clients or I expose to them is because I know what it feels like to have something and not know what I have. And it wasn't until 3 years later that I even realized, even after I converted some of my term to a whole life policy, it wasn't until like 3 years later I realized I had cash value in it because I was looking at a statement and said, what is this money? Are they trying to say I owe this money or this is the only death benefit I have? It wasn't until I called, they said, no, you're growing cash inside of the policy. And that's when I started to dig deeper and I started to go deeper. And it was through my own knowledge seeking that I was able to get a lot of information, which is why these are things you're not going to see and no one's going to sit there and take the time to explain to you. But you need to know why, because it's your money. It's your family bank. And if you are serious about becoming the bank, don't just think about it. I got money here. I could take it out and my money's still earning interest and I go do this. It's like, no, you got to be smart like the bank and you got to move like the bank and you got to be conscious like the bank. And so it goes even further than this. So I hope that I was able to kind of give you guys just a little bit of something different than what I've given you before. And of course, if we do end up meeting, I do, people who met with me know I go further and further. Sometimes I might give you more information than you probably wanted, but it's good to know because, like I said, it's not just about having the trust. It's not about having the insurance policies. It's about having the knowledge. And you may not remember 10,000 things I said or 10,000 things I know, but if you could just hold on to one piece, just one little thing, right? As we work together, that is the one thing that you're going to be able to pass down to your generation, and they're going to be able to say, I don't know nothing else, but I do know my mama Jenna did this, or my mama Angela did this, and this is why she got it. And this, all I remember she said is get this, do this. And that's what I did. And so that is the biggest piece because the true legacy is in the knowledge. And I just want to leave you with this. I know we're focused on becoming your own bank and infinite banking because you can think of the and trust and life insurance are husband and wife. Okay. You can't have one without the other. Okay. Well, I mean, you probably could, but I don't know. But the whole point is they are husband and wife. They are stronger together. Okay. Yes, you can have a trust, but if you don't have nothing to fund and leave a legacy, it doesn't matter. Yes, you can have life insurance policies, but if you don't have a trust to protect the assets and make it flow the way you need it to flow for generational wealth, true generational wealth, then it doesn't matter. Okay. So I like to just leave you guys with this. We always, the way that we, associate, because at the end of the day we could cover it up and say infinite banking and becoming your own bank. It's insurance, it's life insurance. Okay, it's life insurance. But at the end of the day we could sit here and talk about and give it all these different names, but me personally I like to give it the name love insurance. And I told one of my other clients this morning, it's love insurance because one of two things: you love yourself, so you get it for yourself. Why do you say yourself? Because it's not death insurance, it's life insurance. So it's meant for your life insurance. So while you're alive, it's meant for you to be able to not just use in an infinite banking standpoint or becoming your own bank standpoint, but it's also there for you because two things are going to happen. There is no way around it. I can guarantee this. You know how people say don't always guarantee 99%. No, I can guarantee 110%. We are all going to get old. That's a fact. Time stops for no one, age stops for no one. Okay. Unless you found a fountain of youth. If you did, tell me where it's at so I could get some of it. But we are all going to get old. We cannot stop that. We are all going to get to a point where we can no longer do the things that we are doing today. We cannot stop that. And we are all no longer going to be here. Those two things. We're going to get old and we can't do what we're doing today, and we're going to no longer be here. That's a fact, period. And so why do I call it love insurance? Because you got to love yourself to get it for yourself so you can use during your life. When you get to that point and you can't do the things you can do today, you need to be able to tap into the additional benefits that these policies come with, which are the living benefits. So if you can't do 2 out of 6 things anymore, like clothe yourself, bathe yourself, feed yourself, wipe yourself, dress yourself, those things, if you can't do 2 out of 6 things anymore, the insurance company will advance you funds from your death benefit. Okay, that is a fact. So think about how many people out there who grandmas and grandpas, aunts and uncles who may have life insurance policies and they're not well. They're struggling. Social Security is not paying them enough. They are really hurting. They at the food bank, but they got a life insurance policy. But the family just looks at it like when they're not here no more, the insurance gonna pay out. And they may have no idea that they can call the insurance and say, this is what's going on with them. And the insurance company can turn around and say, well, here's an advance to take care of them. So it's love insurance because you got to love yourself to get it for yourself, but it's also love insurance because when you're no longer here, the death benefit, again, people make things more than what they are. It's called life insurance. They didn't make it tricky. It's for your life. That's what it is. But people equate life insurance with just death. It's not called death insurance, but there's a death benefit. That's exactly what it is. It's life insurance with a death benefit, which means if you're no longer here anymore, those you love also receive a benefit. While you're alive, it's for your life. You love yourself, it's for you. When you are no longer here, those that you love, it is for them. So like, if you ever think about it, just think of love insurance. So I just want to leave you all with that. I wanted to take a different route. So I hope I didn't take too much time, Christina. Um, I feel like I was within time, but you let me know.
Yes. Thank you so much, Gerda. We appreciate you coming on and educating the community because you do such a good job at, showing them how the money flows. Is so powerful. And I know that I'm pretty sure that they have questions. Do you have a couple minutes for questions?
Yes, I do.
Okay, perfect. So I want to open up the floor for Q&A officially. So those of you guys who have questions for Gerda, please raise your hand. We're going to respect her time. We're going to go ahead and do Gerda first. And then after that, we'll let Gerda go. And then I will answer your questions based off of the information I went over today. Okay. So if you have questions regarding what Gerda went over, please raise your hand. So we'll open up the floor for Q&A now. And I see the first person is Dina.
Hi, Gerda.
Hey, Miss Dina.
Hi. I know you probably told me already, but how much longer do I have to wait before I can now change the beneficiary on my policy and make it the trust?
Right now. So
Uh-huh.
remember, all we had to do was wait for it to be issued, and
Uh-huh.
issue we can change it. So I'll send you over when we meet on Monday. Just remind me, and I'll send you over the change of beneficiary form, and it'll just be like a
Uh-huh.
DocuSign. Probably do it at the same time we're on the call.
Okay. All
Yep.
right. Thank
And
you.
then just send me, you've already sent it before, so I'll see if I still have it and I'll just attach it and send it over on your behalf. And if I don't have it, then I'll just have you send me a copy of the certificate of trust again so I can attach it to that and send it over.
Got it. Okay. Thank you so much. See you Monday.
Thank you. See you Monday. All right, perfect. I don't know if, oh, yes. I'll just start from like the screen, how I'm looking at it. Jenna,
Hey there, nice to meet you.
nice to meet you.
Great information. Yes, I so appreciate this. So, just real quick, would you cancel the any term policies that you have and just invest that expense, like that monthly payment into the IUL, or like how do you guys look at that? That's my
Yep.
first question.
Yep. So I always tell people if they already have a term in place, another agent might be like, yeah, cancel and come get a policy with me. No, I'm very much so. If you already have a policy with a carrier, you want to then call them and ask them, is your term convertible? If it is convertible, then you want to begin to ask them several questions. So I'll kind of run through it off the top of my head. So you want to ask them, one, is it convertible? Two, if they say yes, is it convertible to a whole or an IUL? They might say it's just the whole. They might say it's just an IUL, or they say you could convert it to either. They could even say that you can split it and convert. Let's say you had 150,000 term. They might say you can convert however you want, and you can convert them into two policies. So you might then say, oh, I want to do 50 in an IUL and I want to convert the other 100 to a whole life. Then they'll be able to tell you that. Then you just ask them, well, what is the cost of the conversion? Okay. And then they'll tell you that because they'll also base it on your current age. Okay. So some of them base it on the time you had it, but most of the time it's your current age because again, these are brand new, these are new policies. Okay. The only thing with the conversions that's even though they're new policies, some carriers, why do I say some? Because there's over 800 carriers and some do different things, but most of the time they won't require you to do a medical exam. So if you have a term and you convert, they may not require it if you're just converting to that.
Okay.
So that's that piece. You also want to ask them, when I do convert, what would it be? What would be the split in terms of the cost of the insurance versus what's going in the cash value? What do I mean by that?
Hmm.
Basically, let's say you had 150,000 term and you said, I just want to convert 100,000 to an IUL. And they say, okay, perfect. Well, then you need to ask them, well, what would be the cost of that 100,000? They're going to say, okay, well, the 100,000 is going to cost you $200 a month, for example. Well, out of that 200 that I pay, what is paying for the $100,000 IUL and what is going into my cash value? They may say, I'm just throwing a number out there. Let's say they're like, oh, $30 is going to come out every time you pay 200 to pay for the 100,000 death benefit and 170 is going to go in your cash value. That's a
Right.
good mix, right? I always tell people if it's 50-50 or higher, Even if they said 100 goes to cash, 100 goes to death benefit, it's still 50-50. It's still okay. It's still healthy. It's when it starts getting where your cash value, a smaller percentage is going to cash value and more is going to death benefit. That's where you're like, okay, no. You then want to also ask them, what are the living benefits that come with your whole life or your IUL policies? Because even though they say, yeah, you can convert, people get excited sometimes, but then when they go back and ask that question, they're like, yeah, no, they're only giving me terminal illness. Terminal illness basically means if you have 12 to 24 months to live, then they will advance you, but it doesn't cover any of the additional medical issues such as like Alzheimer's or can't do two out of the daily living things like chronic illness or critical illness. So
Gotcha.
that's the first thing I would say first, Jenna, is to get all those questions first because it may just make sense for you to convert instead of getting a whole new policy. Now, if they're like, no, we don't do conversions, then we need to talk because then we need to move it over because term policy is really just there. If you don't pass in the 30 years, then
It's
that's just
over.
that.
Yeah.
It's over.
Yeah.
And I use my term personally. So I have a term, I have a whole life, and I have 2 IULs. My daughter is 17. She has an IUL. When she starts working in the summer, I'm going to make her get another IUL. But the reason why I have a term is because the term is just keeping up with my mortgage. Because in my mind, my house is paid off. I owe 200,000, but it's paid off. Why? Because if I pass away before the 30 years, it's paid off. And I got that term when I was young and I was still able to convert a large chunk. So it was like, she's going to get like an extra 500,000. The house will still be paid off and she'll get an extra from the term. But let's say she don't even get extra. The house is paid off. If I don't pass away before the 30 years when the house is supposed to be paid off, well, it doesn't matter because the loan for my mortgage was set up for it to be paid off within 30 years.
Right.
So that's why I don't give extra money anymore to my mortgage at all.
Yeah. Okay.
Yeah.
And so because what we were talking about today is IUL.
Yep. Yep.
And then how does that, I mean, very briefly, like what is the difference between whole and is that the same thing as I get the whole and the universal and IUL, whatever, all the words confused. What's the main difference?
Yep. So they're pretty much in the same bucket in a sense of being permanent insurance. So you have temporary insurance, permanent insurance. The only one that's in the temporary is like that term.
Yeah.
But in the permanent insurance, you have different kinds like accidental death and all of that, but they don't have the cash value component. But when you talk about those three, whole life, IUL, and UL, which is universal life, IUL is indexed universal life, which just means it's tied to the indice. And then you have whole life. Well, whole life, you earn dividends. So it's not necessarily an interest that you're earning. When you break it down to like interest, it comes out to about 5-something%, right? But you're earning dividends, okay? IULs, and I'll do that, dividends. And then you have ULs, which is universal life. Universal life also has a cash value component. Whole life has a cash value component. IUL has a cash value component. All three of them do. Whole life earns dividends you can access within 30 days. However, people get excited when they hear they can access cash value in 30 days, but I always tell people it doesn't matter because if you're doing $200 a month, what are you going to do? And I always tell people don't take more than 75-80% of what's in your cash value at any given time to go do something. So what you're going to do with 75% of $200? You're going to need well over a year to build up your cash value anyways. So with the IUL and the UL, you have to wait after a year to access the cash value. Okay. Now the universal life is a fixed interest rate. So let's just say the fixed interest rate is 5.25%. And the S&P 500 does, if that's the strategy the person chose, the S&P 500 does 10%. Well, Jenna just getting 5.25% because she has a universal life with the fixed interest rate. S&P 500 does 2%. Jenna's getting 5.25. S&P 500 tanks. Jenna's getting 5.25. It is fixed. Now the IUL allows people to capture higher interest rates while it still protects, same thing with the UL, it still protects you from losses. And what does that mean? That basically means if the S&P 500 did 10%, and that was the strategy you chose. Why do I say strategy? Because when I meet with people, I show them how, hey, you can change your strategy. And we do that when we do the annual reviews, if it's merited. But if the person did 10%, great. Next year, it probably was 2%.
Yeah.
Following year, probably 9%. And following year, probably S&P 500 tanked. But the thing is, we call it zero is your hero. The person doesn't lose any money. You just made zero. You didn't earn any interest that year, but you saved yourself from losses. And I rather reduce the losses than bet and risk on the winners, just because I'm very conservative. But that's pretty much what it is. It really just depends on what it is that you want to capture. So like my daughter, she's a young kid, but my strategy for her is IUL. I'll be very
Yeah.
honest. She's young. By the time she gets up there, she's going to have more opportunity to capture way higher interest rates over time. And typically it's been outperforming others in that area. So I would say for kids, it's always not even kids. The younger you are, IUL is the best way to go.
Okay. And the way that you described the loans and like being your own bank, is that really IUL or that's all of them?
That's all of them.
Oh,
It's if
okay.
you
Any
take,
of them.
yep, you
Okay.
take that
So I
policy
still
loan,
like the
anything with
IUL.
cash value. Yep, anything
Got
with a
it.
cash value, you take that policy loan. Now let me digress. That's the gist of how it works. But remember, there's over 800 companies, and a company can say, nope, that's not how we work. But that's
Gotcha.
basic. The companies that I work with, that's how they work.
Okay.
Yep.
And when you were talking about interest, I mean, I got it where you can pay it by the end of that 1 year. You can also pay it monthly, quarterly, like whenever you want.
Yep.
Okay, very good. And then the only other question, and I don't know if this is for you or for Christina,
Right.
is do you create the biz trust for each IUL policy, or place the IUL as an asset owned by the family trust? Like, and then who's the beneficiary? So I don't know if that's you or Christina.
Yep. So kind of two and two, right?
Okay.
Half and half, 50-50. So I'll take the piece about who's the owner, who's the beneficiary. It can be, so there's four parts to a policy.
They was
I'm
digging
sorry.
in there and sure
Oh, wait.
he did something to my computer.
I don't
Valencia,
know.
yeah, there we go.
Hold on, I don't know how to mute. Okay.
You're
So
good.
you have four parts to a policy. You have the owner, the payer, the owner, the payer, the insured, and the beneficiary. The trust can be three out of the four. It could be the owner, the payer, and the beneficiary. The only thing the trust cannot be is that insured, because it has to be a physical person, right, to gauge their health and all of that.
And
Now,
which one? Which
the insured. Yep, the
the
insured.
insured?
Yep.
Okay.
That has to be an actual person. That's who's the policy protecting. If that person passes, the insurance company pays out. So it has to be a physical person. So with that, it then becomes, if Jenna decides, let's say you have the Jenna Business the Jenna Business Trust, the Jenna Family Trust, and the Jenna Ministry Trust, and you decide this particular policy that I got for myself, I want the owner to be the Jenna Business Trust. You could do that. The Jenna Family Trust. You could do that. The Jenna Ministry Trust. You could do that. Who you want the beneficiary, you could do that. It's up to you. Who you want to be the owner of the policy.
Of the death benefit,
Yep,
basically.
of the death benefit.
Who's
Yep.
going
Who
to
the owner
benefit from
is.
that?
It could
Okay.
be different people, because it could still just be you as the owner, the payer, and the insured, and then the trust is just the beneficiary.
Got it. Okay.
Yep.
Awesome. Thank you. Very
Oh,
helpful.
you're welcome. Now, Jenna, real quick, who you prefer as like I know you said like the business trust or family trust, which ones are like the best or whatever. That's a Christina question, because I don't
Okay.
know like what, maybe like whatever she's the specialist when it comes to trust. So she's gonna be the one, which one is
She's
the best
okay.
one and why.
Yeah,
Perfect.
so I'll chime in. So you can put it in any one of your trusts, right? So anyone, the business trust, the family trust, and the ministry trust, all of them can own policies. It's inside of the trust indenture. So typically, if it's a family thing, meaning that the insured are like your children, then obviously you would put it in the family trust, right? So, and if it's like a business thing and you're like the key person, you got to think about it, right? If you're running a business and you're the only person that's, that's running the business, you're the most important person or the CEO, and you still want that business to thrive, then you would put your policy that you're the insured in the business trust. And then some people for additional tax benefits, they'll put it in the ministry trust. So it can go in any one of them. I usually recommend that people just put it in their family trust unless they feel it's necessary to put it in the other two. So it's circumstantial as well.
Okay. And you can get multiples, so I could insure myself in the business trust, and then I could also have a policy in my family for myself.
Yeah. Yeah,
And so
I like the way you think, Jenna. That's definitely the case. It
I
is.
love how you think.
Yeah, I have 5 IUL policies because I
Okay,
have 5 people in my family trust. I have 2 trustees and I have 3 beneficiaries. So all 5 policies are in the family trust. So what
gotcha.
I'm gonna do is I'm actually gonna open up a whole life and I'm gonna put it in the business trust.
Okay. And a whole versus IUL, why?
You know what? I think I don't know. I just think I'm in the position where I want to earn like dividends, and so I want
Gotcha.
to have both instead of just one.
Just one, okay. Okay.
Yeah.
Just a fixed earning, basically, on the
Yeah.
dividend. Yeah,
Yeah.
versus the index going up and down.
Yeah. So I want both. So
Got it.
I want either or. Some people they're like, okay, which one do I have to go with, whole life or IUL? I'm like, why don't you just get both?
Yeah, okay.
Yeah.
Split the hair.
Yeah, exactly. Just get both. So
Okay.
yeah.
Love you both. Thank you so much.
Thank
Awesome.
you.
Thank you. Perfect, perfect. So I don't know if let me see. I see Laura and Maria.
Yep, and I'll make mine quick. So I had some health issues that I was dealing with. I've been wanting to get life insurance, really honestly, since my mother passed away and found out she didn't have any, back in 2021. However, that was around the time also when I had a flare up. And I was told by somebody that I should wait like 5 years until I was totally healed before I get one. Um, is I'm like, I'm just gonna keep getting older. So I'm just trying to figure out like, do you know if it's a situation where it's like, is it impossible to get life insurance if you have a condition?
No, very much not impossible because and I don't want you to when you and I connect, I'll ask you more questions about like your condition, right? But it is not impossible. I have clients with multiple sclerosis, I have clients with diabetes, I have clients, with all these other conditions, epilepsy. So it all just depends. What it will impact is your rating, and what that rating will impact is your cost. Right. And not necessarily something as drastic because you're still young and you're a woman. Why is that important? Because insurance tends to be cheaper for women. Don't ask me why. Well, I know the why because the morbidity tables say we live longer. Okay. So, so that is something that will work in your favor. However, if the person mentioned to you 5 years, and again, you don't have to go into detail here, but we'll discuss in private. But if they mentioned to you 5 years, it could be based on the condition, one, where I'll give you an example. I have a client, he had prostate cancer, but one of the questions the underwriters want to know is, have they been in remission for 5 years or more? Okay, because that to them is an indication that it's under control and won't come back, and it's a lesser risk. Okay, but if they look at it and they're like, okay, this condition that's going on with Laura is something we will approve, but it's going to be on a different rating table, which basically means instead of like um, the standard cost of insurance it would cost a woman your age. Let's just go to let's say you wanted to do $200 a month, and that was 100,000 of death benefit. When you pay that 200 every month, 30 is paying for the death benefit of 100K, and a 170 is going to cash value. Well, they may say, well, based on her condition, instead of $30, it's going to cost Laura 45, for example. So now instead of 170 going to your cash value, you're now going to have, 155. I had to think quick because I was like, I don't want them to think my math don't math. But you're going to have 155 going to cash value and the other 45 paying for the death benefit. The other thing too with the condition may also do something of that nature, or they might not even change anything with that. They may then say, we're not going to change her cost of insurance, but we are going to exclude chronic illness and critical illness. Why? Because maybe the condition you have already falls in that bucket, and they may then say, no, we're going to give her insurance. No problem. It's going to be the same cost. She'll be fine, but we're not going to give her these additional ones, which means like if you can't do 2 out of the 6 things of daily living, that may be excluded because it's a higher risk that that person will fall in there, but they may just give you terminal. Why do I say that? Because I have a client who has these conditions and she was approved. And even though she was on a different rating table, it wasn't that much of a difference for her. I think it was like a few dollars. But they took away chronic and critical because her condition is something that more than likely will cause a higher possibility of her not being able to do those things in the future. So when you and I talk, we'll just talk more because a lot of times what people think is going to exclude them, it's like, no, it just may change the cost, but I just got to get more information from you in private.
Okay, awesome. Thank you. And I do think it's just as a comment, it's so weird that we pay for insurance to deal with situations that they want to exclude if you have to deal with these situations.
Yeah.
Like you realize if you use your insurance, it goes up. It's just so weird. The system.
Insurance is a different type of person. Okay. But it's one of those things where it's like, and here's the thing too, I be telling people because some people try not to tell me stuff, and it's like you gotta tell me because I'm the one advocating for you. I need to know to be like, Laura, no, we not gonna submit an application because they're gonna deny it. Let's talk about maybe another alternative, right? So when people try to keep it from me, and the underwriter comes back and say, I had a client who told me he didn't have any issues, he just was stressed because someone passed in his family. Come back from the underwriter, he done had a stent, he done had heart attacks before, and all of this. I'm like, you could have told me that we could have did another strategy to help you get access to these type of products, but in a different way. Yeah.
Thank you.
Thank you. All right. So Maria.
Hello.
Hello, Maria.
I have a 2-question part. It's very quick and simple.
Yes,
I
ma'am.
apologize for my absence, but I love the presentation today.
Thank
And
you.
I just wanted to ask, will this be recorded? Is this going to be in the um the archives, Christina?
Thank you, Maria. Yes, all of the workshops are recorded and they are available in the portal.
Okay, perfect. I love you, ladies. I thank
Love you
you. And
too.
that
Have a
was
great day.
you
Yeah,
too. I just
absolutely.
wanted to let you guys know that this time it was really awesome.
Thank you so much.
Have a good one.
You too. And I'm just gonna go in order. Mike.
Yes, how you doing?
I'm doing good. I think is it Michael Horns? I feel like I meet with you today.
You do.
Okay.
Yeah. Just a quick question. For myself, I thought other people might be interested in it as well. Are we able to buy a policy outright? So say if it's a cash value policy and I have 100,000, do they throttle how fast you can buy a policy like that, or you have to do it in increments?
Let me
Cash value policy.
cash value. Okay,
Something
and I'm just gonna
yes.
repeat for to make sure I follow. So if you have, let's say, $100,000 of liquid cash that you want to just dump into a policy. Is that what you're
Yes.
saying? Do they?
Yes.
Okay. So no, but there are things that are called like single premiums, which will cause your policy to be a MEC. And what a MEC just basically means is that your policy is now considered a taxable vehicle because it exceeded the maximum amount that you could put in the policy. However, there's a big however. It all just depends on like when we sit down and talk more about, okay, Mike, you got this 100K. What are you trying to do with it? If you're like, nah, I just got the 100K, I just want to dump in here and just kind of let it sit, then it's like, okay, we need to strategize on how we're gonna break up the 100K to make it go into your policy without it being a MEC. Because if you're like, nah, girl, I don't really have no plans too much with it, I just want to kind of move it over here, then these IULs and also with even the whole life, they have different accounts so like for the IUL, it's called a PDA account, which is a premium deposit account. And what that basically means is if you were like, look, I just need to get this 100 out my hand. I don't need nothing to do with it right now. I don't need to be tapping into it anytime soon, but I just need it out of my hands so I don't do anything else with it. Well, we would put that into a PDA account. What that basically means is the insurance company would take the money, they would put it in like their private savings account inside of the insurance company, not your policy. And they would orchestrate, let's say we chose 4 years for them to do the transfers. If you chose, you could do between 4 to 10 years. If you chose 4 years, that just means each year they would transfer basically 25,000 over. However, while it's sitting in that PDA account, it's earning interest. It's like a 4 or 5% interest. So when they transfer it, it's not going to be transferred of 25,000. They might have to transfer 27,000. But because we set up the policy to be able to absorb 100,000, we may then have to just structure it in a way where we put it in the PDA account and then the insurance company does the transfers on their own to be able to move the money for you while you're still earning interest. That's one way. But if you're like, oh, I don't want to do the PDA account, right? Then that's when we have to talk about, well, we now have to talk about what is it you want to do. If you're like, I need to access this money in the next 6 months because I'm trying to go get this real estate investment property and do X, Y, and Z, 1, 2, and 3, then that's when I'll have a conversation and say, well, Mike, I know you want an IUL, but it's the whole life that you need to get because you're telling me you need to access the money within the next 6 months. IULs, remember, you can't touch the cash value till after a year. So that's the only thing. The other component too is this kind of going back to what Jenna asked earlier about the difference with the whole life and IUL. Well, with the whole life, they basically, what you choose for your premium is pretty much your premium. IULs have flexible premiums. And my clients know I call them life is life and premium because we know life be lifing. So if you chose a certain premium, you might have I had a client who chose $500 as her premium a month to do, but then life started lifing for her. And I had to remind her like, hey, you can pay as low as $114 a month and still keep your policy alive. And she's like, I just need it for 6 months. And another one, she started nursing school and she just needed it for that year. And then after that, they went back to their normal 500. So there's different things that you and I will talk about to just really understand more about what are you trying to do so we could talk about what's the real play and how to approach it.
Okay. Okay, that's great. Thank you.
Thank you. Looking forward to connecting with you.
Same here.
Thank you. And then I'm going to go with Zoom user. I don't know who that is, but you have a military outfit on. Thank you for your service. My sister's a captain in the Army. So I don't know who Zoom user is, but I will skip over and I'll go to, is it Tannen?
That's correct. How you doing, sister?
I'm doing good, and yourself?
I'm doing good. I have one question. I know you didn't cover it. The other brother almost had the question. He almost had my question, but
Okay.
I haven't heard you talk about PUAs and how we can get the premiums to be self-paying after a certain period of time, and then being able to pay up without annuitizing the policy.
Yep.
Could you go over that for me?
Yep, and the PUAs primarily involve the whole life policies. Okay?
Yes, exactly.
So PUAs stand for paid up additions. In case anyone's wondering. So it stands for the paid up additions. And just to kind of align it with like what the IUL is, for instance, so kind of the example I gave with the IUL where I was like, okay, Jenna, you pay $200 a month and 30 goes to 30 pays for the benefit, 170 goes to cash value. Well, paid up additions when it comes to whole life policy is a little different where you choose, it's kind of the same, but different, but it's more percentage wise. So what Tannen is referencing is, let's just say a person says they want to do $200 a month. Let's do $1,000 a month, only because my math, I need to make it to math. So a person decides they want to do $1,000 a month and they're getting a whole life policy. Well, the way we would approach it is with the paid up additions, we determine, is it 60-40? Is it 70-30? Is it 50-50? Meaning the higher percentage is what would be going towards that cash value component, and it allows them to purchase additional insurance over time, where essentially the policy, you get to a point where you no longer pay into the policy. So even with like the whole lives as well, you're going to get to a point where you can't put any more money into the policy. Okay. But it allows you over time to be able to purchase additional insurance as you're adding those additional funds into the policy. So, Tana, that would primarily be with the whole life policies versus our IULs. And that is something where we would sit down and to determine, because and also for everyone here who's not familiar with it, it's not a one size fits all. Right. So
Exactly.
someone might say, hey, I want 70-30 because I want 70% of my cash going in cash value and 30% doing death benefit. But then based on that person's circumstance, it may look like, well, what you're ultimately trying to accomplish, a 60-40 split is better. Right. So it really just depends on the person. And we would just have to sit down and like look at your numbers. But it is something that is offered in the whole life policy and something we do go to look further at. Also, too, when I think Laura asked about it up top about the get out of debt presentation that I normally do. So the get out of debt presentation is really just showing people how that we can show someone how they can utilize their whole life policies to primarily accelerate and eliminate their debt at the same time they're protecting their families. And so we look at that to then determine what type of paid up additions does this person need, while we're also able to assist them with eliminating that debt and what's that percentage. So it would be something where we sit down, look at your numbers, and be able to determine, because sometimes too, people come in and they think that I want a whole life policy because I want paid up addition, I want to do this and that. And then when I look at their financial questionnaire and we go over everything together, it turns out an IUL is what's best for them. Or they came in saying, I want an IUL, I want to do this, I want to do that. And we look at their stuff and we're like, yeah, I get that. But what's happening with you right now, a whole life would be better because they may have a lot of debt that we now have to determine how do we strategize the PUAs, those paid up additions, to be able to position them to use the policy at the same time to eliminate the debt in less the time. So a lot of different pieces, but we would have to sit down and look at your stuff specifically to then talk about what you think is what we.
Well, the reason why I ask him, because we've already been structuring in our organization. We're structuring it for major real estate acquisitions.
Good.
And see, we're utilizing we're in a pre-IPO, so when we go public, we're going to utilize the leveraging of the stock, and then utilize, before we spend the capital to purchase real estate, we want to use, and we want to put it into the policy and then be able then to leverage it and pull it out and then go make the acquisition to where we're making our money 3 times over. You see what I mean? So we have been 3 different separate vehicles. So that's the reason why I asked. I appreciate that. You right on point.
You're very welcome. And you got a great strategy, a great play. And then what you do is when you do that, then you pay yourself back. And what do? You wash, rinse, and repeat.
Yeah, that's right. We over here, we recycle our money. We use the same money over and over and over again.
Over and over again.
We never let it leave our ecosystem. Yeah, most definitely.
I love that. I think that sounds like a phenomenal strategy as well. So let us know if you're willing to share, Tannen.
Well, of course. I have
that would be nice. That would be very nice.
1,200 members. Look, y'all, I have over 1,200 members in my cooperative, and I teach and I train them this. And
how would we get in touch with you? Through Christina?
Oh no, I don't know Christina. I'm blessed to even. I'm just getting information from her to help tighten up what I got. You know what I mean? I'm not stealing from you, Christine. I'm just tightening up what I already got. I've been in this game for 35 years, so I'm just doing my extra research and stuff like that.
Yes, we love that. So just share with us.
Most definitely.
You want to share?
Yeah, most definitely. Yeah, I'll put my email in the chat, and all you have to do is just put your information in there, who you are and stuff like that, and then I'll get it over to my vice president and my COO, and they'll send you an invitation over and stuff, so you can see what we're doing, so you can add this component to what you're doing, because we're missing that component. We're missing the stock component.
Yeah,
that's what we're missing. And then we don't know how to take a company public. We don't know how to. We're talking about building all these companies, right? But we're not thinking about how do we create the stock, and then how we create a pre-market value for that stock, and then how we register the stock, and then how we list it on an exchange. See, no one talks about that, right? Then we have an asset. Now we can fund what we need to fund into these trusts. We just have to know all. You have a piece of it, Christina. I have multiple pieces, other people have pieces. We just have to know how to put it together and put it into a system, into a vehicle. So, and then let everybody have access to the vehicle so they can utilize it. That's all.
Extremely powerful. Exactly. And that's why us networking with like-minded individuals is so powerful, because like Tana said, he has a piece, I have a piece, Gerda has a piece, Brian has a piece, everyone has a piece. So this is extremely impactful, and it's not only impacting us, but it's impacting all of our generations. So let's continue to work together. All right, and then now we have Zoom user.
Hi, good afternoon.
Good afternoon.
Thank you for the information. I am learning a lot. I've always been interested in IUL, but I always been told that, hey, it has a potential to be some form of,
Yeah.
so I just didn't dive into it. But no, based on what you're explaining, I kind of get the drift of it, and I'm hella interested, especially in the part where I can create a life insurance for all of my family member, because I'm from the Caribbean.
Yep.
My family do not believe in those type of things. And within the past 6 months, I lost my dad, my grandfather, and my grandfather didn't even have a life insurance. He was blatantly yeah, he was hell bent on not getting one. He doesn't believe in it. And then in the passing of that, that second course, the family had to jump in financially and take care of the funeral expenses. So I guess right now my family finally understand the importance of having a life insurance. But even then, they still won't do what is necessary. They will do the bare minimum. And for me, that is not enough, because again, my mindset is to create generational wealth. And I don't want my offspring to come and have to bear the same thing that I went through. You get what I'm saying? So
Yeah.
this is why I'm here. So I would love to know more as it pertains to the family portion of it, and as well as the investment part of it, because I do have a couple life insurance that's valued like almost $2 million with the
Okay, good.
military, and also personal with Primerica. But
Yeah.
I don't think my life insurance has a cash value. I asked for it, but I'm pretty sure the agent probably, scam her way through it and just give me whatever she feel like just to sell a policy. But that's okay. I did schedule something with you on Monday, so
Okay.
I'm looking forward to that. There was something else that I wanted to ask you. I can't remember. But until I remember, thank you so much for the knowledge. I appreciate everything that both you and Christina is actually bringing to the table. And it sounds like, Miss Christina, we all need to like do an introduction so we can like, you know, maybe bring what type of resources that we have to the table so that we all can say, okay, well, okay, I like this person. Maybe we
Yeah.
can reach out to them. It sounds like we need to do something like that. Because you never know what people has to offer.
Right. Exactly. I love that. That's what I always tell my clients when I take time to like connect with them and talk. I
Mm-hmm.
want to know, what is it that you do? Because, or even not even what is it that you do like for a career, but what do you like to do? Like, what's your interest? If
Mm-hmm.
you skateboard in the park after midnight, I want to know why, because my daughter's about to go to college and I've always wanted to learn to skateboard. So you might have tricks that you can tell me how to skateboard. I don't know, but I just know insurance. But there's other things that you all know that it is a partnership, like I like to tell my clients, and it's the
Mm-hmm.
beginning of a relationship for me. So that's why I always like to know who I'm working with. So I agree with you 100% of knowing like what resources you have in your community and how to tap into it. And like I said, that's how I came across with Christina. We met at a conference and she's become one of my best friends. So just by making those introductions. So, and also my condolences to you and to your family. I just lost my uncle I lost my uncle last week, and my other uncle, I lost him back in July. So I send my condolences to you. And I'm Haitian, so my family, I know the Caribbean, they don't think
Yeah.
anything of it, but
Yeah.
the way that I've been able to draw them in is to help them realize that it's the connotation that is death insurance. That's why they don't want to talk about it.
Mm-hmm.
Like in the Black community, they don't want to talk about it because they're thinking you want them to die so they can get some money and, get
Mm-hmm.
some money. But it's like, no, when you reframe it and help them realize it's for you when you're alive, and when you're not here, we can make sure this and that is taken care of. But once they get to see that,
Mm-hmm.
it really changes the perspective on how they approach it. So
I'm definitely going to try that. I'm going to try
yeah.
it. I appreciate it, and thank you for the condolence. And as well, I'm sorry to hear about your loss. I wish you and your family all,
Thank you. Thank you. Myself as well.
Yes.
Yeah.
Also, you mentioned that you invested in XRP. Are you invested in all of the ISO 222? You
Uh,
gotta double in it.
I
Don't
don't know
miss
what
it.
that is, but when we talk, you need to tell me what it is because I didn't even know what
Listen.
XRP was until my god sister called me back in 2020 and says, Gerda, something's happening. Ben, her brother, he was like, just called and said, you need to get something called XRP. And when I got it, it was 18 cents. I
Yes.
was like,
Well,
yeah, let me get all of this. So yeah, and
mhm.
I only put in 220, like $220, y'all. And I think last time I checked, I was like at 4,000 something. And that was without me buying more. So I'm like, God, let me get
Yeah,
low.
listen.
So it's still low. So get yourself some XRP, y'all. And if it don't
Don't
work, don't say I gave you any financial advice to get XRP.
listen. You might not give them financial advice, but I'm gonna give them. Everyone on this phone call, buy the ISO 222 coins, okay? XRP, XLM, HBAR, ADA, Dogecoin, all of them. Buy them because this is what our banking system is going to start using coming June, July this year,
Yeah.
okay? Please do not miss out on generational wealth because
Yeah.
Bitcoin missed me and I refuse to make this one. I refuse,
Bitcoin missed
okay?
me too. Bitcoin
Okay.
missed me too. If I caught Bitcoin, y'all would not have me on this call with y'all today. Okay.
Yeah.
Because I'd be a Bitcoin millionaire somewhere on an island. I'd
Mm-hmm.
probably be on this call. But it
As you
was so
present,
nice. It was so nice connecting with you. And I look forward to talking to you more.
of course. And as for the person in the chat, just Google ISO 222 on Google. You will see the list of all of the coins. They're all coins. Just buy them.
Mm, yep.
Please, just buy them. Don't forget, please buy them. I'm begging you.
Yep.
All right. That's all I got for y'all.
Thank you so much. Talk to you soon.
All
Thank
right,
you
Britt
so
signing out, huh? Thank you.
Love it, love it.
And it looks like it's two more questions, Christina. And I'll take them real quick and then I do have to log out. So is it Kamala and then Paul?
Oh, yes. Mine is just a quick question. Do you say it's better that the IUL can make more interest than the 401k than you
Oh,
put in your money in a 401k?
oh yeah, because it's not necessarily about the interest rate. It's about reducing your losses, right? Than trying to bet on the winners. And what I mean by that is you can have money in the 401k and you look and you're like, wow, I got 13%, right? But the other thing you want to also pay attention when you look into your 401k is that it does this. It goes up, it
I
goes down.
know. During
It,
COVID, man, because I didn't know any better, I lost like over $30,000 out of my 401k. And
yep,
I cannot get it back until now. It's cannot. I'm telling
yeah,
you. All
yeah.
right. We have to talk more about the IUL thing. Thank you. Thank you. I have
You're
your
very
information.
welcome. No, you're
Thank you.
very welcome. And like I was saying, it's just when and I'm not saying don't have it in there, Kamala, because you want to have a good mix, right? But it just becomes you don't want to have all your eggs in one basket because the
Okay.
basket that we have it in with like the 401ks and the IRAs, that is the risk basket, which means you could wake up just like you say, you lost 30,000. Well, who's to say you can't wake up, God forbid, and now all of it's gone. And
Mm.
when I like to tip, when I say that to people, sometimes people get like, "Oh my God, yeah, you're right." But it's like it's happened before, the Great Depression. There's no way, like it's happened before. It's not like it didn't happen. It's happened before, and that was around even wartime. And so war is not, the United States is not immune to war. So we may not have had a head-on one, but we have had in the past. So it's just one of those things where that was the difference of families that were able to survive through the Great Depression and keep on going. Remember, the Rockefellers are one of the richest families in the world. They have gone through the Great Depression and they still rocking and rolling. Okay. Why is that? Because they had access to money that was done somewhere else that was safe. Just like J.C. Penney, he lost a lot of money in the stock market. He lost everything. And he was only able to keep J.C. Penney going because he was able to get a policy loan from his life insurance policy to keep operations going. Walt Disney World, he went to 301 banks. Some of us, we went to like 2 or 3 and we got denied. And we like, okay, I'm just going to get my credit back in order and try again. He went to 301 banks and they all denied him. It wasn't until he finally realized that he could go into his policy and he got a policy loan and he started Walt Disney World. That's somebody who made money off the same dollar millions and billions times over. Like, wow, no one wanted to invest in him, but he invested in himself though. So that's just one of those things where it's not bad. Keep doing what you're doing, but have your money spread out. Me personally,
Thank you. Thank
I
you.
have money. You're welcome. I have money in different areas, but I'm gonna be very honest with you. Me personally, I have money in different areas, but most of my money is in a policy. That's just it. And if I'm gonna go play in like the stock market or do like because I am gonna get more XRP and all of that, and the thing is to go here to get the money first out my policy to then go do the investment play. Instead of doing the investment play and then it don't work out, God forbid, and I lost it and I have no opportunity to earn interest off of it. The goal is to put the money in the policy first, pull it, kind of what Mike was saying, pull it, then go run the play. So very good. Okay, Paul. And then Christine, I do have to log off after, but I will go ahead and take Paul and then I will have to run. Hello, Paul.
Hello, Miss Gerda. Thank you so much for the presentation. Really appreciate you. Hey, my question to you is: there a way to structure these policies where, I can dump my income in there and also take it out and have it as my living expense as well? I pay my bills out of it. Is there a way to structure it that way? That's what I wanted to know.
Yep. So can a person do that? They can. Is it advised? It is not.
Okay.
Insurance was never built to pay like daily living expenses. And also it's not doing what people think it's doing. Okay. So a lot of times when people would think that they're approaching it where, hey, I put my income into this policy each month and then I take it out and go pay the expenses. It's not doing what they think it's doing because they think it's going up every month by their expenses when in actuality it's not. And so I have just only a few minutes, but I'm going to share my screen with you real quick because I want to be able to really give me one second. I want to be able to really articulate what it is that I'm saying so that way you can see.
So what you're saying, there's no way to obviously I make a monthly income, I dump it all in there, and then maybe let's say I make 10,000, dump it in there, and then take out 6,000 for my expenses, and then rinse and repeat.
You can, but it's not doing what you think it's doing. All you're really doing is a seesaw. You're putting money in, you're taking it back out to go pay the bills, you're putting it in, you're taking it back out of it. You're just doing a seesaw. So, and let me know if you guys can see my screen. It's going to be a lot of scribble scrabble, but I'm going to try to make this as quick as possible. So let's just say a lot of times when someone asks those questions about like, hey, how can I pay, use the bill, put my money in and pay my bills? Well, first of all, you can't really do it if you're just getting a policy. You can't really do that with like an IUL. Why? Because you have to wait till a year to access the cash value, right? So you'd be looking at a whole life. Why? Because you can access the cash value in 30 days. However, reason why it really doesn't make any sense to do it is can you do it? You can. Is it making the impact you think it's making? It is not. It is just a seesaw. Why? So let's just say, for instance, this person has a whole life policy. Let's say let's just say $200,000 of death benefit. Okay. This $200,000 of death benefit, let's just assume, and I'm just going to use numbers, even though like when I was talking about paid up additions for whole life where you have like the percentages, we're just going to assume, let's say that this $200,000 of death benefit for this person, let's say they're doing $300 a month. Okay. Let's say 500. So this person's doing $500 a month, but when they do $500 a month, 470 is going into their cash value, for example, just to make the numbers easy for me. And then $30, I hope y'all can catch this scribble. $30 is going into the death, is paying for the death benefit. Does that make sense so far? Okay.
Yeah.
So now you have this person who comes and they says, hey, Gerda, I'm gonna give you the perfect example. I got $7,000 that I have sitting around that I want to just dump in. So they have 7K they want to just dump in. Okay. So now this person, let's say they got their policy today, they dumped in 7,000 plus they paid their $500 premium. Okay. And I'll put $500 premium here. So they paid their $500 premium. 470 goes where? To the cash value. 30 pays for the death benefit. So now their cash value, let's say, has 7,470 in it. Okay. This person then says, so 30 days later, they're like, yes, I got 7,470. They said, okay, I need to, this 7,000 that I dumped in came from my paycheck. Okay.
Right.
So this is a paycheck. So let's pretend this 7,000 dump came in from a paycheck. This person says, okay, I dumped in my 7,000 paycheck. I called all the people that I owed money to, my bills, and I got an extension 30 days out. So now 30 days comes and they're like, okay, I need to pay my bills. My bills come out to, with mortgage and everything, $6,000 in bills. Okay.
Right.
So now the person takes out 6K for their bills. That leaves them $1,470 in their cash. Okay. When they took out this 6,000, they did what? They took out a policy loan.
Okay.
So they took out a policy loan for $6,000. So next month, when they go, even though they're earning interest off the 7,470, remember the cup and the statement balance I was telling you about? The
Right.
7,470 is the statement balance. The cup amount has 1,470. So now when they need to go pay their bills next month, they're going to need at least 6,000 in there to take out. But what happens? They get paid. They go, they dump what? They dump the 6,000. They might have just put the other 1,000 in, because if they get paid 7,000 a month, they probably just say, okay, let me put 1,000 somewhere else, whatever, right? But the point is they pay the $6,000 loan back, right? To make the balance go back up. And now the balance is back to 7,470. But what are they also doing next month as well? They're paying their $500 premium. When they pay their $500 premium again, what goes into the cash value? 470. Okay. So now they pay that, goes into the cash value. Yes, I'm doing the regular math, how we did in elementary. Okay. So now they go, it goes into the cash value. Now they have $7,940, right? Because they just got paid. They dumped this paycheck in right here, this 6,000 to pay the policy loan back. They also paid their $500 premium, which is their monthly premium. 470 went into the cash value. Now their cash value went from 7,470 to 7,940. But guess what's due now? The $6,000 in bills. So now when we do 7,940 minus the 6,000 in bills, that leaves them with, oh Lord, y'all, I promise, if I don't have a stylist next month, everybody flip the table. Okay. So, so now this person has $1,940 in their cash value, right? Okay. But what happens next month when they get paid? What are they going to do with their paycheck? They're going to pay that 6,000 back. And now they're back to what? 7,940. That's a horrible 7,940. But what do they also have to pay again? They have to pay their $500 premium. And what goes into the cash value? 470. So if you notice, all they're doing with their 6,000 every month is paying it, taking it out, paying it, taking it out. It's like a seesaw. The only thing that's making the cash value go up is what? That $500 premium that they're paying every month, because 470 is getting dumped into it. Now they started off with a high balance by putting a 7,000 dump in, but that 7,000 came from their paycheck. That's why I tell people, no, don't do that, because it's just a seesaw. Now let's just say if you backed it up real quick, and this person, for instance, said, well, I'm not using that. I got 10,000 under my mattress. Let's say I got the 7,000 under my mattress, right? Or not even that. Let's say they got 10,000 under their mattress. Same thing. This person dumps it in. Oh, I got to get it together. This person dumps it in, the 10,000. They want to do $500 a month. Okay. And same thing, we're going to do the same equation of 470 is the cash value, right? And then 30 is death benefit, okay? So now this same person, they dumped in 10,000, they got 470, so now their cash value has 10,470, okay? So now this person says, yeah, that's what I'm starting off with, and I get paid next month, but I got bills. So now this person has $6,000 worth of bills. They take out the 6K, and this leaves their cash value of, what is it, 4,470. So cash value has that. So now they took out the 6,000, they have a policy loan of 6K. Okay. They have a policy loan of 6K already outstanding. As a matter of fact, to make it a little easier, I'm going to actually not do 6K policy loan. I'm going to do, let's say, 3K. This person has 3K in expenses each month. Okay. So that leaves them 7,470. Okay. So this person then pays their normal 500 next month. Okay. And 470 goes in cash value, but they have 7,470 left. So then the bills are, let's say the person's like, I'm not going to put the money back in, because we already know even if you put the money back in, it's just a seesaw. Okay. But if that person took out a $3,000 loan, and let's say next month they're like, okay, well, I got to take another 3,000 out, right? Well, that's another 3,000 out. And even if they put the money in, that's going to bring their 3,000 down to, let's see, 4,470. Okay. So now the person they took out another 3,000 to go pay for the next month, to go pay their bills. So now they got one $3,000 loan out, another $3,000 loan out to go pay their bills, right? They're still paying their 470 each month. So this is still going up by 470 every time they pay it. So now they're 4,940. But let's just say this person needs 3,000 again to go pay their bills. This is a third policy loan. So now this person is either going to end up with a seesaw where they take it out and put their income back in, or they're going to end up with policy loan after policy loan after policy loan, which, as long as you got the money, the insurance don't care, right? But it really is not doing what you think it's doing, because some people think if I put the 7,000 in my paycheck every time, they think it's going up 7,000 each month. It's not. It's a seesaw. So, because you can only borrow what you have in the cash value. So I hope that made sense as to why you can't really use. You can, again, is it possible? It is. I just showed you, but it's not doing what you think it's supposed to be doing, if that makes sense.
I see.
Yeah. So I always just tell people, it's not, insurance was never built to pay bills. So that's the only thing. But I hope I was able to answer the question. I did stay on longer than I needed to. I actually have an appointment I have to run to that I'm actually late for. But I hope that I was able to answer anyone's questions. If you do have questions, feel free to, and you didn't get answered, feel free to email me. I can't see anything else on here except the chat. So thank you so much, Christina. I appreciate you.
Thank you, Gerda. We appreciate you too. Thank you so much for pouring into the community as always. So you guys, you need to go ahead and book a call with Gerda. Her link is inside of the chat so that you guys can have that one-on-one time so she can check out your whole entire financial structure and let you know what will benefit you and your organization. Thank you, Gerda.
Thanks, everyone. Have a good day.
Thank you, Gerda.
Bye.
All right, so we are going to continue with Q&A. So if you guys have any questions based off of the information that I went over today, go ahead and raise your hand so that I'm able to answer any questions that you guys might have. Hey, Tyrone, you have a question? Hey, Tyrone, are you available?
Yeah, that's my bad, family. I had a question for Gerda, but she ain't have enough time for me, but I'll call her later. I just came in late and of course, once again, just trying to finalize some things. But you look gorgeous as always. So I said, let me just go ahead and make that happen. So God bless you. Enjoy your weekend and beautiful kid, of course.
Thank you so much. I appreciate it so much. Thank you, Tyrone, for being here. So yeah, you can reach out to Gerda and her team. They'll be able to answer any questions you might have. So click that link. You can book a 15-minute consultation with her team, and then they'll put you on her calendar so that you can have that one-on-one Zoom call with her, okay? All
Thank
right,
you.
so you're welcome. Next we have Jenna. Hey, Jenna.
Hi again.
Hi, how are
Hey,
you?
fine. I made it. No, I'm kidding.
Right? You guys survived the Wealthy Trustee workshop.
This is definitely a boot camp. No, I love it though.
Yay.
So minus my brain cognitive skills here. A couple quick questions on the quick claim deed. There was an address where it said residing at address of owner.
Mhm.
Okay. Is that the address of the residence of the actual residence of the grantor? Like where that, because it could be a property that isn't primary residency. So is it the property address or the residence of the grantor?
So it's the residence of where they live. So if they live
Even if it's different.
right, correct.
Got it.
Yeah.
Okay. That helps. And then on the business purchase agreement, I believe Texas is where my current business is actually registered with the SOS. And it did not, I just got divorced last year. So I was looking like he was 50-50. And then I went to go remove him and it was like, oh, you just need, it's an S Corp. So I was like, I just had to do it in my bylaws or, like internally. And so it's almost like I don't know how it's registered with the state of Texas, but then changing it didn't require anything. So I'm like, okay, does that make sense?
Yeah, but who told you that? Who told you that
I just went to the SOS, like frequently asked questions to find out about, like back last year, I was like, okay, how do I take him off? Right? As half owner.
Yeah,
And then it was internal.
So when you,
Maybe, maybe not. I could be wrong.
It's not internal. So did you actually search your business?
I'm trying to remember. That would have been a last year thing. So
yeah, I've
not.
Yeah, so I've done it for Texas. I've done it for Texas.
Okay.
So there is paperwork that you have to fill out. But when you search your business, that's the first thing that you're supposed to do is search your own business to see how it appears.
See how it's showing.
Yeah.
Okay.
So if there is someone else that, is on there, you need to remove them from.
Yeah, I need to clean it up, whatever the record is.
Yes.
Okay. And then on the California, if I were to move my car, a bill of sale, I went to your document had California hyperlink. So I went to that form and the first question is purchase price. It just says purchase price. So is that the actual purchase price of the value of the car or is it $1 that I'm transferring?
Yeah, it's $1. So it's not the value of the car, it's how much you are transferring for.
Selling. Okay. Yeah. All right. And I will see you next week because I have other questions that are much bigger and more personal.
We have a call on Wednesday, right?
Yes, please.
Okay. Yeah, I'm looking forward to it.
Thank you so much for everything.
You're welcome, Jenna. Thank you.
Sure.
All right. Next we have Miss Dina. Hi, Miss Dina.
Hi. I was having trouble getting off mute. Okay. Here's the question. Can you lease a building in the trust's name?
Yeah, you can do a lease in the trust and it's inside of your indenture.
Okay. All right. I just wanted to make sure of that. All right. Thank you so much. It's been great. I love you. I appreciate all that you have taught us and have a great weekend.
You too. Thank you so much, Ms. Dina. I appreciate you too. Thank you. Thank you. All right. Next we have Ms. Kamala. How are you?
Hi, how are you? I just have a quick question. For the grantor, can you use the grantor address on all three business?
Yeah, you can use the grantor. Okay, so are you saying can you use the same grantor for all three trusts? Is that where you're questioning?
Yes, yes, and their address. Can I put their address for all three trusts? For the business trust, the family trust, and the ministry trust?
So when you saying put their address, where are you putting their address? I'm confused for that.
Wherever they live as their grantor, because since that person agreed to be my grantor, can I use it for all three for their address?
Okay, so the answer is no, right? So whoever is receiving correspondence for the trust, you have to designate who that person is. So typically the person who's responsible for receiving trust documents is the trustee, not the
Okay.
grantor. So why would you
Okay.
use their address? For what purpose?
Oh, so would I have to get a virtual address because I know I can't use mine?
Correct, yes. So you would have to get a virtual address or find another address that you can use. So we recommend that you get a virtual address. We use a company called iPostal1. So we have a referral link inside of the email so that you can get a virtual address. So it's between $5 and $10 a month, and they will receive the mail for the trust and forward it to you.
Okay. For that one, would I use it for just which one? The family trust, the business, or the ministry?
So every single trust needs an address. So you have to choose if you want to set up one account and have all three of the trusts use the same address.
That's what I was asking. So you were saying no, the grantor, because the grantor have an address, and I wanted to use her address for the all three trusts, but you said no, don't do that.
Okay, so
Yeah.
why, my question to you, Ms. Kamala, is why would the grantor receive bank statements, receive utility bills, receive anything for the trust? Why? If
Okay.
you're the trustee operating the trust.
Okay. Got you. Got you. All right. That makes sense. Thank you. Thank you so much.
You're welcome. All right, next we have KH.
Hello, Christina. Rice is survivorship on a deed, transferring it. The other person has deceased. Is that complicated? Do I have to just file or show them the death certificate when I go file it? How does that play out?
So with the right of survivorship, if there is someone's name that's on the deed and they have expired, you do have to go to court in order to get their interest to wherever you want it to be. So to the survivor or to the trust. So you need to go through the clerk of courts in order to do that.
Okay, thank you.
You're welcome. All right, so we are all done, you guys. We're all done with the workshop. I want to know if there's anybody who wants to come on and let us know what their experience was during the workshop. So if you have any comments, anything that you want to say, or, if you have a testimonial that you want to let us know, basically how your experience was for the last 5 days. So we had a lot going on. We set up 3 different trusts. We got our EINs. We did board meetings. We had educators come in and teach us about credit and life insurance. And then we went through transferring assets. So does anybody have anything that they want to say regarding the workshop? All right, we have
Are we raising hands or?
yeah, we can raise hands. And I'll go to Jenna first, and then I'll go to you, Ms. Kamala. All right, thank you.
There we go. And I think Corliss is trying to raise her hand. Obviously I already thanked you, but this has been, obviously a fire hose of information. But I want to say just from a personal story and briefly is that, I started waking up to the system that we are working in and also not necessarily playing the game at the highest level. So my consciousness started rising a couple years ago, if not 5 years ago. But in 2023, I learned of the word irrevocable trust. And I have been challenged for the last 2 years to find the person that speaks that language. And and I just like poor Laura, I get Laura's experience where she's actually invested a whole lot in people that said revocable. And I knew there was a difference. I knew there was a different game. And I am glad that I trusted my intuition and trusted the divine timing that my answer, my answer would show up. And ultimately I said yes. And but a lot of things needed to happen in that 2-year period that I didn't see coming, which was one, I'm coupling from a 22-year marriage. Perfectly great, all good, we're friends, but it was time. So I learned of it before. I needed to do that before I actually started getting into all this. And because all of that was part of the divine timing. And I just want to offer first, I love that we met, and I love that I was able to be a part of this. And yes, there's a fire hose of information, and I will just go let it simmer until I can organize my thoughts and come up. I have a huge to-do list, and I have a little bit of timing and change because I've also decided to not go back to my maiden name, but completely change my identity in a spiritual way, like like I'm shifting identity in my next chapter of life. And so Jenna Loren is a name that I've created, and I have to go through 2 months of name change in order to do that, and which is a whole nother game and a whole nother process. But with that, that's giving me some time to breathe and allow this to actually be the lifestyle that I live, not just something I do. And raising my consciousness and my wealth consciousness to play, because I can feel the overwhelm. I can feel the like, how much do I need to organize and manage and be the owner of and all of that. But I know that it's important that I elevate, and I'm just really glad that I have you as a partner in that. And hopefully that serves someone else, that we are in the perfect time, perfect place, and the right answer. And that's my testimony. So thank you so much for all that you do. And I know this is a lot for you to do this every month. Like energetically, and you have kids, and I'm like, wow, thank you for giving your time and your energy and your God-given skill and gift. And clearly I see the calling. So I appreciate you more than I know, but more than you know. So thank you so much.
Thank you so much, Jenna, for saying that. You just made me want to cry, but I'm not gonna cry.
I can feel you, actually. I can feel emotions of other people.
My God,
I just felt it.
Yeah, I'm getting all like choked up here. Oh my God.
I can feel your tears.
I'm like lost for words, but I just want to say thank you. So like, just thank you for being here. Thank you for joining the community. Thank you for just, just like adding value and just existing. And it is a lot energetically, and I know that it's like a two-way street. So it's a lot for you, and then it is also a lot for me, but it is a calling, and I'm here to, to do what I'm supposed to do, which is God told me to do this, so this is what I'm doing. And I don't want you to be overwhelmed. So I just want you to take it one step at a time, one day at a time, one moment at a time, one trust at a time, one everything. And I just appreciate, because you've been on this journey for 5 years and you've been looking for that, that person to be a resource, and now you have a whole entire community. And so I'm just grateful that you said yes. And it's just, oh my gosh, it's invaluable. And I don't know, I'm just I'm thankful. I'm thankful.
I know. I feel you.
Yes. Thank you so much. Thank you.
Thank you so much.
Yes, thank you. Okay, so next we're gonna go to Miss Kamala. Hey, Miss Kamala.
Hi, Christina. It's always me on here. I feel like I'm always on here, but thank you so much. The last time when you had it, when I joined in December, I wasn't able to do it the whole 5 days. I think I only did two. Maybe I was lucky to catch the final day. But I was so happy that I was able to sit for the whole presentation for the 5 days. And you did such an amazing job. And I truly appreciate you. And I am so happy to be a part of this community, and I've learned so much because I remember I bump into you on YouTube from after when I listened to Ricky, the health coach, and that guy's a crook. So I should never call people name, but I'm so sorry. But when he finished with this thing, I didn't learn anything. He wanted a lot more money. I couldn't afford him, and I prayed. I said, Lord, I want to get this done. I want to introduce my family to something like this. I hope to God I could find someone that is honest, that could really help, help me get done what I need to get done. And all of a sudden you pop up on my YouTube feed, and I just thank God for you every single day. And I thank God for what you're doing and being able to help me and hopefully a lot of other people in here. And I've learned so much. And the people who you have come on, thank you for that. I've learned so much from them too. And you will be hearing a lot more from me. And I will not put this off any longer. And I've tried to free myself up this year to make sure I am only working 3 to 4 days a week where I could have some other time to get this done, because I really need to get this done. So I just want to say thank you so much for everything that you have done, and have a wonderful and blessed weekend.
Thank you so much, Miss Kamala, for those kind words. I appreciate you so, so, so much. And I thank God for you as well, because I know just like how what you're explaining, it is divine. And I truly know that from the bottom of my heart. I know that for sure. I know that every single person that is led to this community is divinely guided to this community. I have heard so many people say it, and I've received so much confirmation, but in my spirit, I know this to be true. And so you are in the right place, and you're going to get all of the assistance and resources and everything that you need. And
Thank you.
and
Thank
it's
you.
not just me. That's why I invite people like Gerda. Gerda's divinely guided. I invite individuals like Brian, Jeff, and everyone else so that they can come in, because it is absolutely divine. And I'm so grateful for you.
Thank
And
you.
so
Thank
we're
you.
here to hold you accountable. I don't want you to push this off any longer too. So just know that I'm here to help you, okay?
Thank
Me
you. I so
and the
appreciate
entire
that.
team. You're so
And your
welcome.
daughter is beautiful. She
Thank
looks
you
so
so
much
much.
like you.
Thank you. Thank you. Thank you
Okay.
so much. I appreciate you.
I appreciate you too.
Thank you.
Bye.
Bye. Next, we have Mike. Hey, Mike.
Hey, Christina, how you doing once again? First of all, I'd like to tip my hat to you and give you a bow for the workshop and the presentation and all that you do for everybody, directly and indirectly. The workshop was great. I had already went through several of the pre-recorded workshops just to give a base understanding so that I could do more and participate more in the workshop. I was here last month. I'm here this month. I'll see you next month, because for me, the education piece is consistently. So it's a great workshop. The whole course itself, in and of itself, is fantastic. The workshop just puts the exclamation point on it, because the training in and of itself is very detailed, very concise, very easy to follow. If we get out our own way and just not overthink the process. But then when we get in the workshop and the hands-on, it goes from talking about building a house to being able to leave knowing you can build a house when you get ready. So I'd like to thank you for that, and I'll see you next month.
Yay, I love that. Thank you so much, Mike. I appreciate you saying that. And what you're saying is so impactful because the thing about the workshop is you do get to participate and it is on another level. And the reason for the workshop is so that you can feel empowered, right? Like you saying that you could build this house because now you have a solid foundation and that you know that the house is not going to blow away when the big bad wolves or the government or in and trying to snatch it. No, because you have
Yes.
a solid foundation. And the fact that all of our community members have lifetime access. Yes, you was here last month, you here this month and next month. And it's just so,
That's
so
right.
oh my God, it's so powerful. So I'm so grateful that you're here and you add so much value. I hear you on the call. I see you on the chat. And that is the reason why we have this community, because of people like you that are constantly adding value. You are like on another level. Your real estate strategies are on another level. So the fact that you're willing to share is just
That's
so
right.
powerful. Your recommendations, so powerful. You like go to the title company. I'm like, yeah, exactly. Mike. So thank you so much, Mike, for being here. And I'm just looking forward to us, being able to collab and to do life together, because that's what it is. When I tell you
That's
life,
right.
says we doing life together, okay? Till death do us part in the wealthy trustee community.
That's right. That's right. Thank
Yes,
you again.
thank you. Thank you. Have a great weekend.
Same to
Uh,
you.
Thank you. Next we have Britt. Britt, are you available? Let's see.
I'm not sure if that's me.
Yeah.
Oh, oh, hi. I just want to say that I wanted to say thank you to you, and pretty much bringing me everyone that I actually encounter, because it's been really amazing. And you know what's the funniest thing? Just like one of the ladies said, right? I met you on YouTube. YouTube. I don't go on YouTube for the life of me. I don't. And I was like Googling with Chat GPT, hey, where can I find, you know, help with pretty much what we're doing? And it led me to the YouTube video, and I was like, okay, cool. I tune in, and then I start reading your transcript, and then I click on your link, and then it led me here. Would you believe me if I said that it's the first time in my life I sit down and I stay through a course, especially video? I don't do that because my attention span is going to be all over the place. But because it is something of interest to me, I was able to stick to it, like-mindedness. And I love that. I appreciate everything that you taught me. I'm gonna go forth and push forth with everyone that I come in contact with, and I can also, bring them in your team to you, so that they can also be a part of this, because it's not just about me, it's not just about you, it's about people for color that needs to elevate from where they're at, you know, as a group, as a whole, as a race. You know what I'm saying? So I appreciate everything that you have done, the people that you have brought into my life. Like for instance, Mike. um, you know, thank you. Just thank you. I appreciate you. Trust me, I appreciate it. Thank you for everything. I hope you have a wonderful day. I hope you stay beautiful as always with your beautiful soul and your beautiful family, okay? I appreciate it.
Thank you so much. Thank you for saying that. And that is another testimony that is divine, that all of us, we're supposed to be in each other's lives, right? Like you can't make it up. All right. I hear it all the time. It's like, yeah, I found you on YouTube, because YouTube is a spiritual place, right? And so that's how it happens when God is moving in our life, and when our prayers are answered. And that's why we are building this community. And I want everyone to stay connected. And I appreciate you because, like she said, right, it's not about me, it's not about her, it's about everyone. All of us collectively, what we can do together, but also us just assisting one another. So we're here to do life together, not alone. So thank you so much for saying that. I appreciate you so much.
Of course, anytime for you. Thank you. Good
All
one.
right. Next we have Corliss. How are you, Corliss?
Oh, great. Thank you. How are you? Hey, hey,
Doing well.
Frugal. That girl. I, just like her, Britt, I was looking And I just learned about this stuff. My sister Valencia sent me the information like in January. She told me back in December. And she said, I got this person I want you to listen to. It wasn't you, but from that, it snowballed into, and I was like, okay, we are doing this. This is the piece to the puzzle that I've been looking for to get us to financial freedom. And, you know, we're gonna create generational wealth for our children's children. And then I was looking at some video, and then I pop up, and I'm like, your video just show up, and I'm like, oh my gosh! So I listen to it on my way to work because that's what I do when I'm riding in the car to university on my way to work. And I text her, I was like, hey, you got to listen to this. Now I found it, and then you registered for the little Wednesday night theme. And she paid for it. And I'm the person that's sitting through, and it is done. I'm going to have baby step it because I work. And I'm so thankful. When I say my heart is so full of joy, and I just can't explain how grateful I am to have this experience, because you are the missing link to the puzzle that I've been searching for quite some time. And I can finally get off the wheel, the little hamster wheel. Like, I can see it so clearly now. So thankful to all you that are here, and just this beautiful blessing that we have before us. I'm gonna help you carry out this whatever this is we're doing. Like, I'm on the train, and I'm not gonna stop until everybody I know. So thank you. I'm late to work. I'm supposed to be to work at 1 o'clock today. They said you can come in. I was like, I have a class. And so I'm in the parking lot, but I'm about to go in here and hang out with my retiree friends, and throw some cards around. And I feel so good. So thank you so much. You are a beautiful blessing.
Thank you so much, Liz.
Thank you.
Thank you for you and Valencia, the sister duo, came into the community. I appreciate you guys so much. And that is exactly what we are doing here. We are a family. We're building up this community. And I love the fact that you sisters are so supportive, and you guys are doing this collectively. You guys are building that legacy, and just know that I'm here to help. My whole team is here to help. And I'm just so grateful that you guys are here, because I know that we've had one-on-one conversations, and you like, do we have to do this separate? And it's like, no, you don't do it this separate. You do it together. Hello, like, you guys are a team, a dynamic duo. So it's done together. So I appreciate you. I appreciate Valencia, and I'm just looking forward to assisting in any way that you need, and just holding you two accountable. So thank you so much, Corliss. You have a wonderful day at work. Thank you for hanging in as long as you could. And I appreciate you, and you have a good weekend. And I'm looking forward to our one-on-one chats, okay?
All right. Thank you all. Blessings to everybody. Have a wonderful day.
You too.
Peace.
All right. Next we have Laura. Hey, Laura, how are you?
I am wonderful. Thank you so much. Yeah, this has been great. Just like Britta said, I found you on YouTube too, and I usually don't listen to a whole webinar and then buy immediately, but it was a situation where I listened to it, and my husband and I have been looking for a long time, thought we had pieces, wasn't everything. Like, you're giving us what we've been searching for, and it was divine alignment. Absolutely was. Just from the language, I'm a very spiritually in tune person as well. So just hearing and seeing the different types of people that you have been able to attract into your circle, it makes me excited. So anyways, I did not while I did not finish all the trusts, I did finally, like today, I got someone who's like, yes, I will be your grantor. So I'm going to be able to move forward with that. But my question is, so my father, he passed away shortly after Christmas and left me his car. And so I was in a weird space. Did not actually ever get around to doing the registration. Realized mainly because I knew I wanted to put it into a trust. So The car, I have the title, like I literally have the title in hand. Title has my actual name on it. I have all the other paperwork together. I'm just trying to figure out when I'm transferring it to my trust. Do you think it's going to be an issue that like the registration card I have is the one that my father had when it was registered in Tennessee and I'm in Georgia? Do you think I'm going to have to register it first in my name, even though I have the title in my name, before I put it into my into the trust? Or do you think I can just go directly to putting it in the trust because I have the title that says it's now in my name?
Yeah, I was gonna let you know that it might just be that you have to re-register it, so that you have to get an updated registration before you can transfer it.
Okay.
Yeah.
Yes.
No, but thank you so much for your kind words. I appreciate that so much. And I just know that it's a spiritual connection. And that is, that's what we are cultivating here. So I'm just so happy that all of us get to, work together. We get to grow together. We get to really facilitate that circle of trust together. So that's what we are creating here. That's what we have created. And that's what we want to continue to grow and just impact lives and families. So I'm grateful to you and your spouse for taking that leap, and just know that I'm here to assist. Thank you, Laura.
You're welcome. And I'm definitely going to tell my my people too about this, because I've been looking for a good trust program to direct them to. So this is going to be it. This is definitely. Thank you.
Thank you, Laura. Thank you, thank you, thank you, thank you. Appreciate you so much. All right, we have Melvin. Hey, Melvin.
Hey, hey.
Hey, how are you?
Good. Doing great. I'm here at the park with the kiddos. Had to take them outside. I just wanted to say thank you so much for everything, for the simplicity, for the class, for all the love, for the abundance, for the community, for every single individual that's in this call. I want to send you guys a lot of love and light, and I also wanted to say that every time I thought I had a question, somebody had asked it for him. They asked the question. I'm like, you know what? I'm not even gonna raise my hand. I'm gonna just wait till everybody talks, and then if I have a question, I'll raise my hand. Everybody I felt that gave gave a lot into the whole class. It was beautiful sharing the space with all of you and understanding exactly what it is. I've been following you for a while, Christina. And this is the time that I felt was the divine time to take action. And I'm glad that I got into this call with all of you. I'm glad to be within this community, and also to hear things be spelled out so simple, like not in terms where people are trying to confuse you and get, how there's a lot of people out there doing the same thing. But, you are amazing, and you are creating a community and a place that it's beautiful. What happened, baby? Okay, give me 1 second. Okay. Yeah, I just wanted to say that. Let me just handle this. Thank you so much for everything and for every single individual that's here. And I'm looking forward to tapping in with you guys and to creating a beautiful, healthy, loving relationship with you all. Peace and love. Thank you.
Thank you so much for saying that, Melvin. Thank you, thank you, thank you. We're sending you a lot of love and light for you and the kids. And I just, like, every time that somebody talks, I just know like that is like there's a spiritual connection there. So I feel like all of us, collectively are our soul family, and we are supposed to be collaborating some way, somehow. We're supposed to be in communication. We're supposed to be assisting each other, impacting each other's lives in any kind of way. And so I'm just so grateful that you are here, that you took that leap of faith, because like you said, right, there are other people that teach trust, right? But it's all about alignment. And so it's not only that that I'm in alignment with you or you're in alignment with me, but also that all of our community members are in alignment. So I am so grateful to everyone that's here on the call, everyone who attended the workshop, everyone who is in the Wealthy Trustee community. I just want to say thank you to all of you guys. I love you. Me and the team are here for you. To assist in any way. I hope that you guys have a beautiful and amazing rest of your day, the rest of the week, the weekend, everything. And so I want you to know a few things. One is you guys have homework, right? So the homework is to book a one-on-one call with me so that I'm just able to help you guys. If you want to get structured, I just want to help you guys brainstorm, okay? Because we're here to hold you accountable to make sure that you actually do it. So get on my calendar so that I can answer any specific individual questions that you have, based on your business or your family. So book that call with me. And then also I want to be able to double check your trust documents. Okay. So I want to be able to double check, the business trust, the family trust, and the nonprofit. So please jump on my calendar. Me and the team are here to assist. So book that call. Book the call with Gerda if you guys, are interested in getting some more information about the insurance. Book the call with Brian if you guys are interested in OPM and funding. And you guys are also going to receive a survey. So it's already in your inbox. So it's a survey on your experience with the workshop. If you have a few minutes, please go ahead and complete the survey because it just helps us. It helps us to make your experience better, which is what we want. So we want to bring you the right information. We want it to be timely, and so that survey really does help us. And the last thing is that we have a Q&A session next week. So you're going to receive the information via text message, email, Telegram, and Facebook. And it's going to be on Tuesday at 7 p.m. Eastern Standard Time. So it's going to be a Q&A session with me and with our CPA. So I'm going to answer all the trust questions. Our CPA is going to answer all of the tax questions, okay? So if you have the time and availability, please join us on Tuesday. I don't know what day that is, but Tuesday at 7 p.m. Eastern Standard Time. So with that being said, I love you guys so much. And I hope that you guys have a blessed rest of your day and an amazing weekend.
You
Bye.
too. Thank you, everyone.
Thank you, Jenna.
Thank
you.
Thank you, Miss Tina.
Thank you, everyone.
Yes, love you guys
Bye,
so
everyone.
much.
Thank you.
you.
Thank you. Have a good weekend.
Thank you too. Thank you, Shannon.